Story that we want to be watching out for as well. Best performing sector so far this year in Europe, car sector. Keep an eye on that one as well this morning. We're watching out to see how that performs. Anyway, European equity markets are about to open. The headline that's really caught my eye, though, over the last few minutes, European weather. Spain to exceed 28 degrees next week as spring sets in. There is hope for us all. Let's take a look at what these markets look like as we come through in terms of the opening trades here in Europe. We are looking at a positive picture. That certainly seems to be the sense. In terms of some of the single stocks I'm watching out of the gate first thing this morning in terms of the impact, Shell is higher this morning. Schneider's also picking up a little bit of a trade as well, but it does look like energy stocks are going to be the early leader. And it looks like maybe the FTSE 100 is already benefiting from that, up by circa 0.5% already. LVMH up by 1%, bouncing back after yesterday's move.
Yeah, we should very quickly mention some of the BMW heads that are crossing the Bloomberg terminal. We're looking at global sales rising something like 1.1%, rising 2.5% in the first quarter. You're seeing sales drop, however, in Asia and China, but they're still saying that kind of consumer growth story happening in the States and happening in other parts of the world as well. So we'll have to see if there's a bigger read-through as we get a little bit more volume kind of flow through.
Absolutely. So there's a little story that's just dropping on the screen right now. BMW EV sales climbed 28% in the first quarter. So we'll come back to that BMW story in a moment. As I say, that is the sector that has been outperforming all others so far this year in Europe. In terms of the main sector stories that we are watching, though, look at all that. Green on the screen, pretty much across the piece. Banks rising. Remember, we get JP Morgan reporting Friday. The bank story will front and center by the end of the week. But everything looks like it's having a fairly solid week, fairly solid start to the day, though.
Yeah.
Basic resources up really quite nicely. Energy also rising too. But it's like a reasonably balanced market, it looks like, this morning. Most sectors seem to be rising and having a positive performance.
But you know, when you see that kind of breadth, that immediately is that kind of a autopilot trade? Are people sitting back and just kind of riding the wave as opposed to kind of taking bigger positions? ASML, for example, is going to be your biggest index mover on the stock 600 in terms of the early trades that you see, not to mention one of the top movers in the Euro Stoxx 50, I think.
Absolutely, but is that a TSMC read across?
See, that's the part I can't tell, and we can ask our next guest this in a moment. But is that a fundamental story, or is that a when you don't know what is going to happen next, you just dive into?
If you're buying a basket, ASML is going to be a big part of that basket, isn't it? We'll talk about the kind of the Super 6 in just a moment. Kind of those key stocks. If you're buying Europe this morning, you're going to be buying those key stocks.
Can I just say, you go from core 6 to super 6 to sensational.
I'm kind of making it up as I go along.
It's like a...
We had 6. I think that's the critical thing. We could get our 6 on a graphic. These are the 6 stocks that we are paying attention to.
Yeah, it's really interesting. And look, it all comes in the kind of background of some of the fiscal story as well. We talk about monetary policy. We talk about the fundamentals. The macro matters. Take a listen to what Catherine Nice over at PGIM had to say to us earlier.
In the decade before the pandemic, it was really monetary policy that was in the driving seat. Fiscal was really in the back seat. You know, austerity was the rule of the day. And we're basically seeing a flip of that. And it's fiscal that is in the driving seat. It's doing the heavy lifting, supporting economies. And it's monetary policy that's in the back seat, trying to restrain things and ensure that nominals don't run away from us.
Catherine Nice, the PGIM Chief European Economist, there joining us earlier in the program. I want to get a little bit more context in terms of the market read-through of what she was saying there. Frederic Carrier joins us this morning, Head of Investment Strategy for the British Isles and Asia over at RBC Wealth Management. Frederic, a pleasure to have you on the program. Let's talk about that fiscal impulse there. It makes a lot of sense from a European perspective or bond perspective, but when it comes to the equity market, What's the read-through?
Look, earnings. We need to see earnings growth, particularly in Europe. We expect subdued but still some earnings growth, and valuation levels are very attractive, particularly if you take European stocks. If you exclude the tech sector, the discount of European stocks to the US is at the deepest, the biggest discount since 2011. So we see some value, and we think that people have an old conception of European stocks. Many of our clients still think of Europe as being the home of telecoms, utilities, very much like they were 10, 15 years ago. And as you alluded to, there are now a lot more exciting growth-oriented companies which are part of the index.
We're talking about tech.
She's talking about the six there, by the way. Just wanted to make that clear.
You know what? I don't have a hat to tip you, but noted. Guy was right, guys. It's okay. It happens every once in a while. Frederic, talk to us about the defense story, though. This kind of mini correction that we're seeing in the defense stocks. We don't usually talk about defense valuations. It's coming into the narrative now at a time when we really don't know how to quantify that fiscal expansion, the investment from a lot of these European governments. Your take on the defense sector?
So, look, it's a sector that's done very, very well over the past 18 months. Valuations are now 22 times. On average, historically, it's been 16 times. So a lot more expensive, but really it's a new paradigm in terms of defense in Europe. So it's a sector that we see as still being very conducive to investments. Clearly, there's some ESG issues, but if you think that governments will continue to invest, national governments to invest in defense, defense spending has gone up 80% over the last 10 years. So we think there's still some potential. I would say that a Trump victory might create some hurdles in the sector.
Yeah. Maybe a need for more spending, though. That could certainly be part of the narrative.
Yes, we're also looking at the European Parliament elections and whether the right-wing parties start to have a lot more influence in terms of policies. They are not so happy about a European defense policy, so that could crimp growth. But the overall mega trend is for more investment in defense in Europe.
How cheap is the UK? Do I want to own the FTSE 250 right now? The discount is enormous.
There's lots of value in the UK.
Yeah, but is it? When does that close? I feel like I've been talking about this for quite a while.
You've been talking about that. We've all been talking about the valuation case for the UK for a very long time. Look, we don't see really an opportunity to close that gap in a sustainable basis. We look out for elections. Perhaps some political stability will help reduce that discount somewhat. But really the point is that the UK lacks these stocks which people are looking for, the growth sector, the technology. The role of the UK equities has really diminished over the last 10 years. It's now 4% of global indices.
Yep.
And people, institutional investors are just not putting the resources in order to really look at this stock market. So yes, there are some value stocks. We look at particularly global leaders which trade at a very steep discount to their peers which are listed elsewhere, but it's not a market which we see as having a lot of potential. Clearly, a rally in energy stocks could really help it, but it's difficult to make the case to really invest in this country at the moment.
I'm confused about the case for investing in Europe broadly, and hear me out, because you hear two different narratives, and that one, it's European markets on the continent here in the UK are international markets at their core. So a lot of their kind of read-through, a lot of their revenue comes from the States, and therefore it is a catch-up trade that's at play. On the other side of the equation, it's more of a macro story, which is there's some sort of reacceleration of the global economy driven by the States, and therefore the cyclical, more capex, industrial kind of tilt that these European markets have will favor that kind of pro-cyclical play. Which is it? Because those are two very different stories.
It can be a little bit of both. There is definitely a resurgence of stabilization in European growth, which will help companies. Overall, for the index, about 40% of earnings still come domestically, so it is important. But you have also these international companies, these global leaders, which happen to be listed in Europe and trade at attractive valuations, sometimes at discounts.
Do valuations even matter if we're talking about a catch-up trade, though?
Well, a catch-up trade, if it's cheap, yes.
But Europe has historically been cheap. Like, are we comparing it to the U.S.? Because Europe will always be cheap relative to the U.S.
The growth dynamic is different in Europe, yes. But valuations, it's always more comfortable to talk about a catch-up trade when there's a valuation.
Do I buy European equities if the Bank of England and the ECB are cutting rates? Is that a catalyst? Is that a potential catalyst to make me want to think about it?
So to have supportive monetary policy helps. And we see the economy in Europe stabilizing, and particularly wage growth improving, real wage growth improving if inflation declines. So for us, it's more looking at these variables than necessarily one rate cut.
Okay, but if we see divergence across the Atlantic, I'm trying to figure out kind of for the catch-up trade to carry on, what ingredients do I need to see?
We need to see the growth improving slightly in Europe. That's what we need to see. Now, the European growth is never going to be like the US. It's a much more regulated. It's economy, aging population. Yeah. But what we need to see is a slight improvement. Already we saw less deterioration, stabilization, and what we need to see is a slight improvement. So growth north of 1% next year would be already good enough to provide some earnings momentum in Europe.
So then bring it back to the valuation story. What is there a threshold where you say this is too expensive, this is not worth it?
Valuation levels at the moment are not suggesting that. But yes, they would be at one point. If you look at the discrepancy, the discount becomes really starts to close down, then yes, then it has happened in the past that European equities have become a little bit expensive.
We don't have the growth, but we do have Florence. I'm just going to point that one out.
I'm happy to, take one for the team, invest.
And visit Florence. Spend a little bit of money.
Charge to the Bloomberg Amex. Eat some more ties,
even more ties.
Yeah.
More ties. I got a tie out of Critty's trip.
There are Vespas on it.
There are. In terms of sectors in Europe that we should be watching, autos has been the big outperformance so far this year. I'm surprised to see industrials doing what they're doing right now. Do these kinds of trends continue? If Europe is going to continue the catch-up trade, where is that kind of at a more granular level going to come from?
So industrials is a good place to start. We like those which are particularly underpinned by the mega trends. So the electrification, the digitization, defense is another one. Less of a catch-up there, but still some growth potential. We also like technology, the whole semiconductor supply chain, and mission-critical software companies. Healthcare is another important play for us.
Novo Nordisk has done quite well.
It has.
Frederic, thank you very much indeed. Nice to see you. Frederic Carrier, Head of Investment Strategy for the British Isles and Asia at RBC Wealth Management. We'll go back to the Core 6 and just show you exactly what's happening. We call them Sensational 6. I think Core 6 probably is maybe the best way to go. They're all higher this morning as Europe gets a little bit of a lift. Novo is only up a little bit, but look at that. LVMH, Ferrari, Novo goes negative. LVMH, Ferrari, ASML, Schneider having a really good day, Nestle, all tracking a little bit higher. So the Core 6, this is kind of the core of the basket, all having a relatively good day, with the exception of Novo Nordisk. But it's had quite a good run. Those are some of the core stocks. What else are we watching this morning? Let us find out with Joe Easton.
So these are how the defence stocks are opening up at the moment. We're up a couple of percent for Rheinmetall. That was one of the big droppers yesterday, down as much as 7%. And the other stocks, Thales, Saab, Leonardo, all gaining. As you were discussing with Frederic just a moment ago, some of these stocks trading at 20 times their earnings now. So we're not seeing a complete retracing of the move yesterday, but we are seeing small gains with some buyers coming back into the market on those ones. We've also got our eye on chips, as you mentioned earlier. TSMC in Taiwan reporting some some really strong growth, a really good month for that company. So most of those stocks are gaining in Europe in terms of ASML, Infineon, ST Micro, the peers. We have got a big decline for Ikestron, though. This is as it gets a downgrade over at Exane BNP Paribas. So that one is standing out if you're wondering why that one is red today. Then a couple of single stock movers to bring you. We did mention earlier that news around Philips, and there's the gain, 7%. That's the best gain for that stock since December last year, so the biggest gain in 2024. They are looking to resolve the issue around their sleep apnea devices in the US. A court has approved their agreement. They say it will help them move on and start producing some of those devices soon again. Then in terms of chocolate, one of our favourite stock sectors for sure, Barry Callebaut over in Switzerland. That stock was up 10% at the open. It's up 7% at the moment. It is one of the largest makers of chocolate. The big rise in cocoa prices, though, that is actually negative for the company, given it's their main raw material cost. So that stock's down a lot already this year, but rebounding following some strong volume numbers today. Then we'll move over and have a look at a couple of the broker moves. We've got one for Edenred. This is one of the worst performing stocks on the market today. We've got Jefferies going underperform. Multiple headwinds is what they're saying. One of them is competition in their food voucher programs. This is a company that make vouchers. They sell them into companies and they are given to staff, and they say there's competition there. That stock on a bad run, down 3.9% at the moment. Finally, it's those fancy cashmere sweaters doing well once again. Brunello Cucinelli, this stock had a really good run following some recent earnings, and they've got another outperform, another buy rating over at Oddo BHF. They do rate that one and outperform, and that's up 1% in Italy, 98.25 at the moment, 110 price target upside in cashmere sweaters according to Oddo. That one's up in Milan.
All right, Joe Easton from our equities team, we thank you so much for walking us through the stocks to watch. Coming up on the program, at least 3 people have been killed after an explosion at an Enel hydropower plant in northern Italy. We're going to have more on that story next. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The deal? The deal.
The deal. That deal. The deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit Search Go to find answers now.
This is Markets Today. We're about just shy of 20 minutes into the European trading day. We are seeing green across the stream. The Stoxx 600 higher by about 0.7%. A lot going in their favor. Fairly broad rally that we are seeing this morning. I want to bring you some headlines that are crossing the Bloomberg terminal here. It looks like Chinese leader Xi Jinping is due to meet the former Taiwanese president who ruled from 2008 to 2016. Of course, a self-ruled democracy there, marking the very first visit from a former Taiwan leader to the Chinese capital. It's largely expected to be a symbolic gesture, or at least that's what they will be watching for. And this, of course, report coming from TVBS over at Taiwan. Another major story in the Taiwan space is TSMC. Their quarterly revenue growing at its fastest pace in more than a year. The result shoring up expectations that a global boom in artificial intelligence development is fueling demand for high-end chips and servers. Tim Colpin from Bloomberg Opinion joins us now this morning. Tim, walk us through the numbers here. What did we learn?
So the numbers came in at just ahead of TSMC's own forecast for the quarter at about $18.8 billion US dollars. That's about 13% for the quarter, higher than a year ago. It's interesting to remember that last year, even though chips were kind of hot, TSMC had a decline in revenue last year, but they're not going to have a decline this year. They're already forecasting a very solid year, and so this is a very nice first quarter to get out of the way. And there's a lot of news ahead of us for this year, a lot more great chips in AI that are going to come online, as well as smartphone chips and all sorts of other things that TSMC is going to be making for the rest of the world.
Tim, huge amounts of demand for its products. It is broadening its manufacturing base. It's now going to be manufacturing in the United States following the announcement with the Biden administration that it's going to build factories in the US. How big a difference are those factories going to make to the overall footprint that TSMC operates?
Well, it's going to cost a lot of money, $65 billion over the next few years. But unfortunately, I'm sorry to burst the bubble of the US that thinks it's going to be suddenly a semiconductor king again. It's going to account for like not even 10% of TSMC's global capacity, somewhere around 5 to 7% of global capacity when it's all up and running. So it's not a big deal for TSMC. They're doing it mostly for political reasons. They are getting a bit of I guess you'd call it a kickback, these incentives that were announced recently. $6.6 billion US dollars sounds like a lot, but again, out of $65 billion of expenditure, it's not that much. But it's all political. TSMC is really very much stuck in Taiwan. They will be for the foreseeable future. We have earthquakes here, we have typhoons, we have the risk from our neighbor over the other side of the Taiwan Strait. So there's a lot of kind of geopolitical risk in Taiwan. But that doesn't change the fact that TSMC is here, and what it's going to do in the US is important symbolically. But in terms of production, yeah, not a big deal.
Tim, I can appreciate how it is a symbolic gesture. I'm curious if that symbolic gesture even lasts going into the next administration. Are there concerns about that on the ground?
Well, there is a sense that, obviously, if there is a new administration coming into the US after the election this year, yeah, maybe things will change. But right now, it looks like this is pretty much set in concrete. It's passed through Congress. Commerce and Treasury have the rules out there. Gina Raimondo has announced these incentives that it will go to TSMC. Other companies like Intel and Samsung are getting them as well. So I don't think there's a sense that it'll all be rolled back. It would be very, very unusual if a new administration came in to roll it back, but anything's possible. TSMC pretty much is committed, at least for a few phases of its plans. So I think it's pretty much going to be all steam ahead.
You mentioned Intel. Let's talk a little bit about Intel for a moment, Tim, announcing a new accelerator that it hopes will allow it to compete to a certain extent with NVIDIA. Do you think NVIDIA's worried?
Yeah, I don't think they are. Look, this new Gaudi 3 chip that Pat Gelsinger announced this week, it looks kind of good. He says it's better than NVIDIA's older chip, but it's probably on par with NVIDIA's latest chip. It's going to come out later than NVIDIA's latest chip. So I don't think NVIDIA will be quaking in its boots, to be honest. And, let me tell you something ironic. It's good for TSMC, because even though Intel is starting its own foundry business, which competes directly with TSMC, this new Gaudi chip will be made by TSMC at their 5-nanometer process. So whether people go out and buy an NVIDIA chip or an AMD chip or an Intel chip, TSMC still gets the revenue.
Yeah. You can see those numbers strong this morning. Tim, thanks for the catch-up. Really appreciate it. Tim Culpen from Bloomberg Opinion, what's happening in the chip space. Let's turn our attention to something that happened in Italy yesterday. We're continuing to track what the news looks like. So Bloomberg has learned that at least 3 people have been killed, 5 seriously injured. We're still looking for people as well. This after an explosion at a hydro power plant in northern Italy. This is kind of between Florence and Bologna in northern Italy. Rescuers still very much looking for survivors. Let's get an update with Chiara Albanese. Chiara, just kind of walk us through what this plant does and what happened and how this accident took place.
Yes, the plant really uses the power of the nearby lake and river to generate energy, and is a plant that operates underwater. What happened yesterday in the afternoon, there was an explosion below the surface of the water. So a lot of people are missing at the moment. 3, as you were saying, have been confirmed dead, but it's very hard to continue the rescue operations because those are happening underwater. So at the moment, the focus is really on rescuing the missing people and trying to understand the extent of the damage, which is very hard to do because it's 9 levels below the surface.
Has there been any clarity on how Enel has responded or any kind of understanding of how this took place to begin with?
The company has not said much. Until now, they have said that they are cooperating with the authorities. The CEO of the Enel unit, which was operating the plant, Enel Green Power, has gone on location, but there are still a lot of questions lingering about what happened, responsibilities, and which other contractors were operating the site.
Okay. Chiara, is there a grid impact here in terms of Italy's electricity supply? This was, as you described it, effectively a hydro plant that stores electricity. It's basically a kind of water battery for the electricity grid. Do we know how long it could be out of action? Clearly, we're obviously still in the kind of the search and rescue phase of this. But what is there a longer-term potential impact on electricity supply?
So for the moment, the lack of supply from that plant has been compensated from other sides. The Italian grid has been compensating, so there are no shortages in supply. Clearly, the damage over the long term, if the plant will require months of work to be operational again, will be felt by Enel and by the Italian system.
All right, Bloomberg's Chiara Albanese, we thank you so much for joining the program. This is going to be something that we continue to monitor, of course, on Bloomberg Television and radio. But coming up on the program, we're going to take a look at the oil space and the wider commodities read-through as well. Francisco Blanche, head of global commodities over at Bank of America Global Research, will join us. We'll talk about the read-through, not just from the Middle East, but from the United States as well.
So oil's been trading higher. We're kind of circa $90 a barrel right now. Gold's been on an absolute tear. Copper's been moving higher. Even iron ore's starting to tick higher as well. Commodities traders are making a lot of money right now. Does this trend continue? And what's the inflationary impact of all of this as well? That's going to be something that we're going to be talking about with Francisco. He is coming up next. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
This is Markets Day. We're about 30 minutes into the European trading day. Green on the screen when we look at those equity markets. When we look at the commodity markets, a little bit of green on the screen there as well. Especially look at 89 handle on Brent crude, 23.56 on gold. But I'm going to really zero in on the oil story. Oil holding a 2-day decline after a report points to rising U.S. inventories, Middle East tensions, OPEC plus production curve expected to cap losses. There's a lot to dive into. Luckily, we have the perfect guest. Francisco Blanch, head of global commodities over Bank of America Global Research, joins us on set this time. We're thrilled to have you. This oil story, how much of it is fundamentally driven? How much of it is just a momentum trade?
Well, I mean, there's a lot of fundamental drivers here at work. We've had, remember, since the Houthis started shooting at ships in the Red Sea, we've had a lot of disruptions, but importantly, we've had longer trade routes, faster ships. Ships are on average 10% faster than they were pre-war, so that takes a lot more fuel. So a lot of the world commerce is really kind of picking up, and then we have, of course, an important uplift in cyclical conditions, right? Yep. It's one of the reasons why everyone's wondering if the Fed is really going to cut rates or not in June. We started the year with 6.5 rate cuts, remember, priced then, and then we've quickly moved to maybe 2.5, right? So the economy is better. We have longer routes, more geopolitical risk, and of course, any news of a potential ceasefire in Gaza are going to be leading to a bit of a sell-off, because maybe that means you can reopen the Red Sea to all that shipping traffic and reduce the pressure.
So from what I'm hearing from you, it does sound like the tensions in the Middle East are actually factoring in to the oil price at a time when I think a lot of people were struggling to see whether these kind of tit-for-tat measures between Israel and Iran were having some sort of more direct read-through. You're saying they are.
No, I mean, I'm talking specifically about the Red Sea, right? I mean, commodity markets don't tend to price risk until it kind of happens, right? Commodity markets, they see a little risk, they build up a bit, but it's really when we get that big disruption, when we get that shut-in of production, that refinery being hit by a drone, that things start to move. Because, you know, it's really hard to price something that hasn't happened, and you know if it's going to happen or if it's not going to happen, or maybe it is. So,
do I buy or sell commodities if the Fed doesn't cut rates?
I still think you want to be in commodities, Guy, and I think you want to be. This is a great time to be in commodities. We're seeing gold, oil, copper, the entire lot going up, and part of it, right? I mean, we had a 2-year decline from the Ukraine invasion into the first quarter. And since the first quarter, all these factors I talk about on the demand side, things getting better, but also importantly, we're starting to see supply issues emerge in commodities like copper. We just revised our forecast. We have a $12,000 target for copper. We revised our gold target to $3,000. And we still think oil hits 95 into the summer months. And this is the asset class that I think is going to help you a little bit if the Fed decides not to cut rates and you have a sell-off in bonds and equities. But if they decide not to cut rates, it's likely because commodities are going up and inflation is resurfacing, right? So that is the reason you own commodities in this cycle.
Let's break that apart. Let's start with gold. How price insensitive are central banks right now? Because it doesn't matter if bond yields go up or down, inflation goes up or down, anything goes up and down. Gold seems to be rising right now. Are these price insensitive buyers?
In a way they are. And what we've seen is this buy the dip mentality by central banks. And why are central banks buying gold? Very simply because central banks don't trust central banks.
Right. So this is an inflation story. Do you think this is a trust in the financial system trade?
I think it's both, right? I think it's an inflation story, but it's also trust in the financial system because of what happened to a Russian central bank, right? Remember that when Russia went into Ukraine, they had $650 billion in reserve assets, and a few weeks later, they had half the money. And this is a permanent member of the Security Council. So if that can happen to Russia, it can happen to anybody. And what we've seen is a widespread buying of gold across the central bank community. And this doesn't go just for, let's say, traditional foes or adversaries of the U.S. or, commercial rivals like China, which has been buying gold for a while. It's just also your allies are buying gold. Countries like Singapore, countries like Turkey, NATO members or traditional defense allies or former British trading posts, right? And they are buying because they say, well, the world's fracturing. We have a big geopolitical fracture at work. And where do we sit here, right? In Singapore, yes, traditional U.S. British ally, but lots of Chinese people. Turkey, NATO member, but very close to the Middle East, very close to Russia, right? Yeah. How do you balance all that out? And the answer the central banks are coming down to is gold. And then, of course, there's the inflation story. And let's not forget the budget story. We can't seem to be able to fix our own government budgets.
Yep.
How much of it as well a growth story coming out of China? It's interesting that you're talking about this kind of bullishness in commodities when Chinese weakness is so prevalent, European weakness is so prevalent. Is the U.S. consumer story or the U.S. resilience enough to support gold, copper, and oil?
So not every commodity is going to rally. That I think it's clear. This commodity is going to be somewhat soft. But I think, first of all, China is doing a little better. We've seen PMIs pointing up. We've seen new orders in China, specifically doing a lot better. The housing sector finding some stability. And global commerce is starting to pick up. Because remember, for the last couple of years, as rates went up, inventories went down. And inventories go down because corporate managers, they find it more expensive to finance those stocks. So we saw finished goods inventories, intermediate goods inventories, commodity raw material inventories coming down, and now we have to rebuild them because we're not going into recession. The story is not so much that the world's booming. The story is that we're not going into recession. So we need to rebuild stocks to meet the demand that's not going away, despite the higher rates.
People have been talking about a copper shortage for a long time.
Yeah.
Are we here now? Is that it?
We're here now. We just put a report out yesterday saying that the copper supply crisis is here, and we think that this is the one commodity that's going to really benefit from the energy transition.
How do I make that work?
Well, there's mainly two ways. So you can buy commodities directly, right? Whether it's copper, ETFs, futures, or exposure to a commodity index. Alternatively, you can also buy some of the equities. Now, I'm not an equity analyst, but there's a range of equities that Bank of America recommends that you should be buying to get exposure to the copper idea. And we think copper is going to be at least 30% higher over the course of the next 12 months, maybe more. If you're talking about insensitive price buyers, look for people that need to build a grid, need to improve the electric grid. Yeah. No matter what the price is, you got to build those data centers. They're coming through. You need to have the power to do it. You need the grid. You have a lot of renewals because you want to transition, and you need to connect those renewals to the grid, and you need to improve the grid, and that takes a lot of copper. And you also want to have your electric car. All of that, like I said, is a big confluence on the red metal.
We've covered a lot of the metals. We've covered oil. I need to throw a curveball at you, talk about the soft commodities here. Yeah. The inflationary story seems to be picking up that it's more goods-driven inflation, commodity-driven inflation. Services may start coming down. Are you seeing that trend in food inflation as well, grains, et cetera?
So the agriculture complex is a bit split. You have certainly a lot of pressure on the soft commodities, but you have a lot less pressure on the grains. Now, let me explain why that is the case. So the grains are highly integrated into the energy supply chains. Ethanol, right? Corn-based ethanol. Biofuels like biodiesel. I mean, they're based off soy. There's a great connectivity, that complex to the energy complex. If energy really starts ripping, you're going to see those commodities move higher. Now, the supply side is very fragmented there, so it's difficult for corn to double and triple again, because again, there's so many farmers, right? Yeah. Now, the soft commodities are different, because soft commodities are highly concentrated in a few countries in terms of supply, and you know, we're seeing with cocoa, there's also starting to see pressure. We're starting to see pressure on coffee, right? So we may have to find peace.
It's getting serious.
I was going to say, talk to me about gelato inflation, espresso inflation, all those things. That's the mindset I'm at.
Coffee and chocolate. Now, yeah, that is
coffee and chocolate.
This is serious stuff. So yeah, we've seen the concentration. You said if we really see inflation, if we really see energy rip, what does energy ripping look like to you?
Well, I mean, I think we're looking for $95 a barrel as a target, right, for Brent. Could it go a lot higher? It depends a little bit on the Saudis, right? I mean, the Saudis hold a lot of spare capacity. They got 5 million barrels a day. OPEC collectively has sitting on 5 million barrels a day of spare capacity. So I don't think it's going to happen necessarily, right? They'll open the taps. It's an election year. The last thing they want to do is interfere in the U.S. election, in my view, right? So they'll try to keep a price stability. That's what they're out for. But there could be a policy mistake. Or there could be another geopolitical event. Or maybe demand ends up being a lot stronger. Because in this post-COVID world, we all want to spend rather than save, right? So, which is ultimately what this is about.
All right, Francisco Blanch, head of global commodities, equity derivatives, and cross-asset quantitative investment strategies over at Bank of America Research. We have thrown everything at him, and he has handled it.
The takeaway is that coffee prices are going higher and chocolate prices are alady pretty high. That's
breakfast of champions, I think.
If marmalade prices go up, we're in real trouble.
Ew, what? I can't. If we go from the oil story, the commodity story, the marmalade story, to perhaps one a little bit more serious, Europe's defense stocks up slightly today after a big slide on a Goldman Sachs warning of peak multiples on defense firms. We're going to dive into the nitty-gritty but next. This is Bloomberg.
Part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we could deal with in some way?
It's a real challenge for a lot of families, mine included. You know, I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly. We want to be there for her, but it's painful for us to see the toll dementia has taken on her. So this is rightfully, a concern for families across the country. We're investing a lot in studying dementia to not just Alzheimer's, but other forms of dementia to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California, San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. And this is a promising area.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Big sell-off in defence stocks yesterday. Today we bounced back a little bit. European equities broadly bouncing back, as you can see, but we're kind of parking this story. We're waiting for the CPI print a little bit later on. But defence definitely got dinged up by a GS note, Goldman Sachs note yesterday, maybe talking about stretched valuations. We do seem to be coming back quite nicely off the back of that. Let's kind of look into why maybe that trade was put on yesterday. Ollie Crook joins us from Berlin. He's been tracking this sector. Ollie, yesterday's price action, was it just we've pushed it a little too far and therefore maybe it's time to take a few chips off the table, but the trend is still intact? Or is it maybe the trend's starting to get a little too, maybe the trend is starting to come under a little bit of pressure as well?
I think it's probably more the former than the latter. I mean, we had the worst sell-off in about 18 months for many of these names. Saab was down as much as 10%. We're clawing some of that back right now. And I think a lot of people, though there wasn't a really very clear sort of news catalyst, we're tracing it back to that Goldman note, which were really talking about the valuations and looking at the PEs. And what they were looking at specifically was a 45% premium for these defense stocks over the stock 600 versus the past, where they usually traded at about a 7% discount. But again, we need to put this into context, Guy, of what we've seen over the last 2 years, really, because that really makes all of the difference. And you really need to pick your superlatives here because there are just so many. Looking just at Rheinmetall, we're talking about a stock that has rallied 450% since the invasion of Ukraine, the third best performing on the MSCI World Index. And I was looking at the price to earnings ratios. Right, Rheinmetall trades at a higher PE ratio than Apple. These are all things that were completely inconceivable a couple of years ago. And I think for investors trying to figure out what this new world looks like, getting pricing out into the market is going to take a little while.
Ollie, how does the politics play into all of this? We just had Francisco Blanch talking to us about these kind of politics behind a lot of these pledges, basically. What is the read-through into the corporate side?
Yeah, so what I think is very interesting is you have the EU elections coming up, and you have this sort of thought that potentially it will go much more to the right. And you had some guests talking about this on a little bit earlier. What does that mean for the sort of defense spending? What I think is interesting is that I think everyone is more or less unified on what needs to happen here, which is much more spending coming out of Europe to the defense sector. The question is going to be how you pay for it, which has been the crucial question for us on Bloomberg for a very long time. But there are really only four options, right? You can raise taxes, raise debt, cut from other parts of the government budget, or grow yourself out of it. Growing yourself out of it has not really been the European strong suit. If you're looking at cuts to other parts of the budget, that's always very difficult politically. You're talking about raising debt. There is not that much fiscal headroom across Europe, and raising taxes is raising taxes. So I think what you're going to see is the right going to be sort of much more in favor of cutting across welfare and taking the money there, whereas the other side of it is going to be maybe raising collective debt. But as we know, and Guy, Creedy, we've spent many, many years talking about this very contentious issue in Europe. Can you really get there? And the question is, for investors, they need to plug all of these different variables into a very complex equation of basically trying to price this new paradigm. So I think for these defense stocks, it's fair to say we haven't arrived quite at that price just yet.
Yeah, it was interesting. Francisco was talking about just kind of where does the metal come from? Where do we get the kit to build the stuff that we need, or where do we get the stuff to build the kit that we need? It is an open question as well. So many variables in this story. Ollie, thanks for the update. Greatly appreciated. Ollie Crook joining us out of Berlin on that story. Oil kind of holding a little bit of a two-day decline. We're kind of in and around the $90 a barrel story on Brent. Simmering tensions, of course, in the Middle East, presenting potentially bullish tailwinds. Israeli forces preparing for an offensive in in Rafah. We're keeping an eye on what is happening there. We're looking for the Iranian response to the attack on the consulate we saw in Syria last week. Ramona Mubarak, head of MENA Country Risk and Global Banking, BMI at Fitch Solutions, joining us now to give us an assessment of this. Let's start off talking about that Iranian story, because on Friday we were trying to work out what that response would look like and whether it was something that the energy market would be having to pay attention to. We haven't seen that response yet. We're all scratching our heads trying to work out what ultimately it's going to look like. What is your assessment of how the Iranians are going to deal with this story? What does that look like?
Well, the MENA region is currently at an important junction between a ceasefire and escalation with possible Iranian retaliation and expansion of ground operations into Rafah. So the Iranians and media reports pointed that they are linking their retaliation to a ceasefire, a negotiation, or a possible successful negotiation into the ceasefire. Now, that said, risks that Israel will go into Rafah and failure of the ceasefire remain very high. So, for instance, if the Israeli leadership considers concessions difficult to offer in the current negotiations, then we will be looking at an invasion of Rafah. And in this case, Iran has three choices: retaliate directly, indirectly through its network in the region, and not retaliate now. And each scenario has its own implications on geopolitical risks in MENA and the oil markets.
Okay, let's just talk about some of those probabilities, Ramona. Is the base case still for escalation, or is it increasingly looking like de-escalation?
Well, we're more likely now leaning towards a ceasefire in terms of so de-escalation at this point in time. Several factors are converging that makes a ceasefire more likely now than, let's say, prior to the key events that happened over the past week or so. First, the international pressure on Israel is rising, especially after the killing of the 7 World Central Kitchen Aid workers in Gaza. Domestic pressure in Israel on the government to release the remaining hostages, especially that after 6 months of war, they failed to secure their release and neutralize Hamas military capabilities and leadership. And 3, the credible risk of Iranian retaliation. This last point is a bit critical because this event specifically goes against U.S. interest of keeping current turmoil contained in the region and oil prices at a level that does not lead to renewed inflationary pressures, especially in an election year. So the conversion of these events kind of provided an opportunity for the U.S. to step up its pressure on Israel to make some concessions. Israel did withdraw most of its troops from Gaza and increased aid entry into the Strip. And also on Hamas sides, these concessions plus Qatari pressure and now Iranian pressure will make this group more likely to accept a ceasefire. So overall, we're leaning towards de-escalation. And in all cases, even if you link it to oil prices, the premium and the geopolitical risk hasn't been high. So kind of aligned with what the story on the oil market is saying now.
Ramona Takriti in London, when we look at the Iranian output story and potential sanctions that may actually follow, in the last year or so, there has been an uptick just based off OPEC data we get on the Bloomberg terminal in that Iranian supply story. What are the prospects of more barrels hitting the market?
More Iranian barrels hitting the market at this stage. So last year, Iran did ramp up its oil production. But it's unlikely to let's say, lead to a similar increase this year as well. This is mostly because of China's economy, and China is the main import market of Iranian oil. So the story or the possibility of Iranian ramping up their production is unlikely in 2024 on this at this moment.
Ramona, you talked a little bit about the regional response as well, as opposed to the kind of containment strategy of the United States. Talk to us about Jordan. Talk to us about Lebanon very quickly, if you can, just given, I think, Jordan has the largest Palestinian population outside of Palestine itself. Walk us through the kind of regional ramifications between those two regional economies.
Well, yes, Jordan does have the largest population of Palestinian origin in the region, and it has seen some protest against the war, protesting against the war in Gaza over the past 2 weeks or so. So now, if you look at it from what's happening, so the longer the war in Gaza continues, the riskier the situation will get. But in our opinion, like, this will remain contained. It will remain directed at a specific event, which is the war in Gaza, and not escalate to a point that it will jeopardize or put at risk security conditions in the country. For Lebanon, the situation is a bit trickier. Because we have seen recently increased in some domestic tensions, but also a sustained increase in the intensity of fighting between Hezbollah and Israel. But like, while the confrontation is now at a higher trajectory, it's still below the level of a full-scale military confrontation, and we don't see this happening in Lebanon. This is not our core view. Hezbollah has its own domestic consideration to factor in when it decides to escalate and if it decides to escalate.
All right, Ramona Mubarak, head of MENA Country Risk and Global Banking at BMI Fitch Solutions. We thank you so much for joining the program. Of course, we're going to watch the oil read through and the commodity read through off the geopolitical story there as well. A couple of other things on our dock. At about 12 p.m. UK time, we get some data out of the States. U.S. MBA mortgage applications, which traditionally isn't that exciting to watch, but we do want to keep an eye on the housing story, which is likely to be a really big input or potentially output of the U.S. CPI data. That coming in about 1:30 p.m. UK time. Does shelter move the needle for the Federal Reserve? At 6 p.m. UK time, more coming out of the States. This time, in terms of liquidity, in terms of supply, we've got a 10-year note auction worth about $39 billion. And at 7 p.m. London time, we do get those Fed meeting minutes are going to get released, plus the U.S. monthly budget statement. There is actually a lot to digest there. So I feel like in 24 hours, we've got a couple of different trading stories. It's not just inflation.
I think that probably will dominate. But we've also got Bank of Canada to throw into the mix as well. The auction story, I think, is going to be fascinating. 10-year auction today, plus also the CPI print. Are we heading towards 4.5? Do we go beyond 4.5 on a 10-year? People are talking about 5. But real divergence beginning to emerge in terms of people's views on what the Fed does next.
It's still striking to me that liquidity is not a concern anymore. And I think it's simply because that positioning story that we had Aline on earlier. Because I remember Bob Michael over at JP Morgan Asset Management, CIO fixed income there, a couple of, like, maybe 6 months ago at the end of last year had kind of said that there is insatiable demand for bonds. Look at the positioning story. No one's diving into bonds kind of head first the way that maybe they did earlier on. And I'm curious if that's why the liquidity story has kind of dissipated, and maybe if it'll come back given some more geopolitical
Some of the
risk.
funding story on the credit markets as well has also been heavily front-loaded into the first half of the year. So it'll be interesting to see as that starts to eke out what impact that has in terms of pricing as well. But I don't know, the next 24 hours, you've got a few Fed speakers to throw into the mix as well. Some of those are coming after the CPI print. What are they going to do in terms of the narrative that's coming up? 1:30, I'm definitely going to be tuning in.
Well, we've had a lot of kind of stories of divergence in terms of the story there. For me, it was Raphael Bostic's comments basically saying that, look, maybe it's not labor that we should be paying attention to.
Yeah. Tomorrow's ECB day as well.
We didn't even talk about that.
Which I find amazing. I was talking to Anna about this yesterday. I find it absolutely amazing.
Oh, we'll do plenty of that tomorrow, of course. Well, that does it for markets today. We've got the pulse up next. I'll be walking you through it. We're going to talk about some of the major stories, corporate, macro. We've got it all for you. Stick with us. This is Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London with the conversations that matter. Here's what's coming up on today's program. European stocks rising ahead of inflation day in America. Are the hot CPI numbers from the last 2 months a one-off or a two-off? Bear with me, I had to say it. China pushes back against fish after it downgrades the nation's outlook from stable to negative, warning that the country is likely to pile on more debt. Plus, in the corporate space, it's the AI chip boom that continues over at TSMC. Its quarterly revenues growing at their fastest pace in over a year. Now, in the meantime, let's get a quick check on those European markets map. You're seeing a fairly broad rally across the continent. How much of that is kind of this autopilot wait-and-see mode ahead of that inflation data, or how much of it is truly driven by the defense story? We're going to dive into all of that at the moment. Again, green on the screen when it comes to the European trading session. Let's take a quick check on what futures are doing across the Atlantic, because you are seeing futures higher, but marginally higher. When you look at the S&P futures, we're looking at 52.65 on that contract. Slight outperformance at NASDAQ 100. Again, nothing major to write home about. But that being said, how much of that changes the game when, one, we get the CPI story, and two, perhaps some of this European kind of sentiment feeds into the European trading session. The cross-asset story is also worth looking at, simply because the commodity story is on a tear. Brent crude retreating a little bit from that $90 a barrel handle, but you were still at 89.81, higher by 0.4%. Usually we see like a 3-5% move off the geopolitical risk. How much of that is taking a little bit of a breather, again, ahead of those inflation numbers? Gold is higher as well, 23.52, unchanged at the moment. But again, sticking at those record high levels, is there a valuation concern in gold given the central bank buying that we're seeing, given the inflationary hedge? We're going to dive into all of that as well. Plus, iron ore is higher, even dollar yen, 151. We are on that intervention watch still. But of course, we're going to keep you apprised of all of that. There's a lot to digest there. Lucky for us, we've got the perfect guest to do it. Ursula Marchioni, BlackRock International Chief Strategist for EMEA iShares, joins me this morning. Pleasure to have you on the program. I don't even know where to begin because there's so much to digest. Let's take the easy way out and talk about the CPI data. How much of it is going to be a story of the labor market that we've been paying attention to for a while, as opposed to other inputs like housing, commodity-driven inflation, airfares? What's your take? What are you watching?
Yeah,
Well, first of all, thank you for having me, Kriti. It's great to see you. It is a very important day and an important week because, to your point in the opening, we're really facing two different scenarios here. The first one is one where the January and February reading at 0.4% in terms of core CPI solidifies our outliers, and so there's no path there that we need to worry about, or a scenario B where actually it becomes difficult to justify the fact that actually that isn't a trend. Markets are very much positioned for the first scenario. So if I think about not only what markets are pricing in terms of Fed cuts, but also looking at where investors have been voting, where they've been putting money thus far, it's very clear that that's what we're preparing for. We are seeing a broadening of the rally, exchange-traded product flows, if you want to use that as a barometer of what global investors are doing, continue to be strong, 126.5 billion in March alone, adding to very strong readings for January and February. And again, within that, it's been fascinating for me to see last month how cyclicals have come back, how European equities are in favor within that small caps. So you can clearly see a strong voting towards that scenario. So again, if today gives us a different view, I think we're going to see money in motion, and we're going to see a significant move in terms of how investors will rethink their portfolios.
You said my favorite two words in financial markets, which is fund flows. Talk to us about the currency story. How much of that is impacting the fund flows? There's some sort of thought process. Guy and I were talking about this in the last hour, where the currency picture, weakness, or some sort of kind of breaking of cable or breaking of the euro is going to incentivize those flows into European stocks at a time. We're talking about kind of this catch-up trade. How much of the currency picture matters at a time when we are incentivized to find the cheap deals out there?
Yeah, it's a very good point. I guess my answer would be to the currency point. We have seen a change February into March into global appetite for European equities. So in Feb, it was very much coming from US investors, and so to your point, the currency element was a big component of that. In March, 3.3 trillion went into European equities, and of that, about 2.8 came from European. And so again, the currency element being less of a factor there. And as I mentioned, 20% of it going into small caps. So you can see attention towards valuation being extremely cheap. It's a interesting moment, I think, particularly for investors in the region, because again, also looking into ECB later this week, tomorrow, there's quite a lot at stake there. From a currency perspective as well, I guess the other element that I would flag is we continue to see appetite against this broad backdrop of risk-on sentiment for emerging market equities. And so again, there we looked at high 20s into Jan and Feb in terms of billions of inflows. That continued in March, although with more granularity and selectivity in terms of countries, India being a beneficiary of that. And that picture is very much in contrast with emerging market debt, where we see outflows, although we at BlackRock personally like the hard currency component.
You've thrown so much at me there. Let's dive into the ECB story as well, because it feels like monetary policy has been driving the trade globally for such a long time. Guy and I talk about this quite often, and Anna as well, in that perhaps it's the fiscal this time around that's actually driving out performance, especially in the periphery that you're seeing in Spain and Italy and Greece, et cetera. But I'm curious why that isn't getting priced into the markets, because it feels like markets are far more sensitive to, is the ECB going to cut first, as opposed to, is Giorgia Meloni going to be spending more money here? How do you square that? How do you price in the fiscal impulse?
Yeah, I agree with you. I think that is a conundrum in terms of particularly that element in the strength of the purchase from European domiciled investors. I think taking a step back, if we think about this week, going back to last month, Madame Lagarde mentioned we will know a little more in April, we will know a lot more in June. And so again, she set the bar for action this week at a high level. And again, if you take a step back and look at what has happened between then and now, in terms of the facets that are monitored, inflation outlook, transmission mechanism, to your point, there isn't a lot that has changed. Yeah. So Look, I think that the picture for us remains intact in terms of, a likely June start. It's going to be interesting to see wording use. Unlikely that she's going to commit to do something then, but for sure, to your point, that is the picture that we're looking at.
What does that do in terms of appetite for boons, arguably for gilts as well? But let's focus in on the ECB as well. In terms of kind of Italian debt, French debt, German debt, are you seeing appetite there?
No, Kriti. So of the 126 billion going into ETFs that I mentioned, about 98 went into equities. It's been an extremely lackluster month, and actually year to date for fixed income. We've seen this big rotation into risk on. It does, permeates into fixed income. We see credit buying, but again, in terms of magnitude, if I look at March, we saw 7 billion going into fixed income, vis-a-vis last year, where 60-70% of the flows went into the asset class. And so I think against that picture, it's clear that the big fixed income trade from a portfolio reallocation perspective has unfolded, particularly towards the second half of last year, and now investors are moving into equities. And so, that is, again, I think why this week is so important in terms of could that be shattered or changed.
All right, so we talked about the bond market, talked about the FX market. Let's talk about the commodity story and the read-through there into equities, because it felt like there was, at least for some time, this question of, do we start to see some sort of outflows of equities driven by yields at a current level, currency at a current level? Yep. Now that we are even talking about it, and I want to say talking about it very cautiously, $100 oil on the horizon, potentially, if the momentum continues, does that change the game for equities, or is it enough of a gradual move that it's digestible?
Yeah, and I think you're right. It could be an important additional piece of the jigsaw in terms of the inflationary element that is supporting the story. I think from a commodity perspective, we are seeing some movements. So interestingly, we saw in March the biggest month of record for silver exchange traded products inflows, while gold remain in outflows. And again, you mentioned earlier, spot gold price at record high. And so you can see some profit taking and some nervousness around that. And silver becoming a bit of a proxy trade, I think, in terms of accessing there. But in terms of magnitude, again, we're looking at 1 billion in, vis-a-vis the 98 that I mentioned went into equities. So I think the attention, the intensity through which global investors are looking at the two asset classes, speaks for itself through these numbers.
What's the go-to hedge here? If you're worried about the laundry list of issues that we have, geopolitics, election, et cetera, what's a sure thing in the next 12 months?
So I think a good balanced approach would be to continue to remain, first of all, very dynamic and nimble from an asset allocation perspective. So anything that relates to set and forget portfolio construction practices is risky at the moment for all the reasons that you mentioned. And then I think, look, a good balanced approach is, equities through a quality lens. So if I think about US equities, the AI mega falls playing out so spectacularly there, Japan, if we were to think about going towards the end of this week, US financials, earnings, looking at that component and see how that evolves. Europe potentially through a quality lens. I think these are, with the caveat of remaining nimble and making sure that we never forget we live in a highly macro volatile environment. These would be, I think, 4 areas of good balanced opportunities for portfolios.
What do you not want to touch right now? What is poison to a portfolio?
Well, poison is a very strong word, but I think that, for example, if we look at fixed income in the US, we're definitely very much positioned for the short end. We wouldn't go into the longer component.
What's the logic there? You caught my attention there. What is the logic there? Why not? Is that a deficit concern? Is that a housing concern? Why not go into the long end?
Yeah, it's a bit of a blend in terms of, if you think about the growth picture for Europe, it's more mixed than what we see in the US. And so for European duration, we've seen investors going back in, and we see the logic in terms of re-entering from a portfolio perspective that component. For the US, I think it is not the time, and so short updated are the right component. Another area of funding for portfolios, so again, it's a zero-sum game. If we think about funding for all the areas that I mentioned earlier, Japanese bonds, we prefer equities there, and so again, that is an area where we've seen investors make a move to deploy towards more interesting asset classes.
The Japanese equity story. Okay, well, you brought up Japan, so we've got to talk about the bond market very quickly. The BOJ initially was expected to kind of hike once and be done. Now there are questions of, do they hike further later in the year? Do we see currency intervention? I'm very curious about this carry trade that the yen has been funding, basically. The Swiss franc to some extent as well, but the yen really. My personal theory is that it's led to this very low volatility environment because the carry trade is so attractive and so easy to kind of execute at the moment. What margin does that carry trade dissipate? How many times does the BOJ have to hike? What levels in the yen are we watching where that carry trade is no longer worth it?
Yeah, I hear you. So look, I think a scenario where we see one more hike between now and year end is still a benign scenario because, again, we're looking at strong earnings, supportive corporate reform. There is enough there to actually continue to support a positive view for Japanese equities. And again, it is a gentle path that they're on. So I wouldn't necessarily place a high probability to a derailing of that scenario. But I agree with you that that would be the mark that we would have to watch for. And so, yeah, I would say one until year end is probably what feels right.
And is there a currency trade-off there, but what we see with the Japanese yen relative to, see, the yuan or the Korean won? Is there a kind of export trade dynamic that we need to be paying attention to?
So certainly it is something that investors are looking at. So again, going back to my point in terms of the flows and how we see investors reading the region and reading the question that you're posing, that significantly greater granularity that they are placing in how they access the region, to me, is the answer to your question in terms of they're clearly unbundling the exposures so that they can have that
pulling out,
correct. And so I think that there is something there that investors are deeply reflecting on and acting and voting with money in motion towards.
I'm curious how much the geopolitics reads into that. But I've got to let you go. I could keep you on here forever. Ursula Marchioni, we've thrown everything at her. BlackRock's EMEA Head of Investment Portfolio Solutions. We thank you so much for joining the program. We go from the macro, which we've done plenty of, to the micro and talk a little bit more about that geopolitical risk in the context of TSMC, where quarterly revenue grew at its fastest pace in more than a year. Investors saying that AI boom will continue. We're going to dive into it next. This is Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it is continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
Tesco has forecasted a profit increase this year after an easing in costs, allowing the supermarket chain to cut prices and attract budget-conscious shoppers. I'm going to get a little bit more on the story with Bloomberg's consumer goods reporter Dasha Afanasieva joins us to explain a little bit about this. Talk to us about the Tesco strategy here in terms of dealing with inflation.
So like all of the supermarkets and the consumer goods companies, it's gone through sort of almost an unprecedented level of price rises. And it's been that delicate balance of increasing prices, protecting margin, but also not losing market share too much. And Tesco has done pretty well in that sense. It's managed to actually increase operating margin without losing market share. And I think that now, there's a question mark over how the extent to which it's going to keep being able to do that.
The inflationary story, though, do loyalty cards have a read-through in there? We talked in the last hour about whether you put them on a keychain or on your phone or like an Apple Wallet, for example. How are they faring in terms of that strategy?
So that is very core to Tesco's strategy of cutting prices. And when they talk about having the lowest prices amongst the main supermarkets, so not the discounters, they're actually talking about the lowest prices if you have a club card. And at the moment, the Competition Markets Authority is actually looking at these in terms of whether they're good for consumers or not. And that might really impact Tesco's strategy and also Sainsbury's, which is promoting, is using the Nectar card quite a lot. And we also had this lawsuit recently where Tesco's branding for its club card was actually found to be too similar to Aldi's logo. So it's actually going to have to redesign its logo and get a new one out in weeks.
A lot on their plate, but I always feel like when design is at play, there's always, it could be interesting or it could be a train wreck. We'll see which side Tesco takes. Bloomberg consumer goods reporter Dasha Afanasieva joining us with that crucial context. Plenty more to come. Stick with us. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal. The Deal.
That deal. The deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Wow.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
TSMC's quarterly revenue grew at its fastest pace in over a year. There's a lot in the nitty-gritty here. Tim Colpin from Bloomberg Opinion joins me now to break down some of the numbers. Tim, over to you. Just kind of give us a sense of what we're looking at here for TSMC.
Well, for TSMC, any growth is good news after revenue fell last year. Up about 13% for the first quarter. The numbers just came in a few hours ago. They actually met the top end, in fact, slightly exceeded their own guidance at about $18.8 billion. So all around good news. It sets them up for what's going to be a very, very good year for TSMC. AI is the story behind TSMC right now. 10 years ago, it was all about smartphones, Apple, Qualcomm chips, all that kind of stuff. But right now, it's NVIDIA, AMD, even Intel, which is getting into the AI space. And it looks like that could have a few years to go. So not just this year, but the next few years could be very, very good for TSMC.
Tim, talk to us about what gets in the way of that. There's a lot of questions about whether geopolitical risk does, more investment from the likes of Intel, for example, bringing manufacturing onto U.S. soil. What gets in the way of TSMC's further success?
Well, I think nothing's really going to stop TSMC's top line. The sales will keep going. The revenue is still there, you know, barring some kind of catastrophe, economic slowdowns, wars, whatever else that can happen. But really what could be the big challenge for TSMC is costs. They are setting up in the United States. They're also setting up in Japan and in Europe, in Dresden, in Germany. So these are places with much higher cost base without the engineering talent, no offense to those places, but they don't have the engineers that Taiwan has. So they're going to have to hire people, pay them a lot more money. And so all of that expertise and experience that they have in Taiwan and they're trying to replicate overseas is going to increase costs. So margins are going to be an issue. And then geopolitics is really behind a lot of this expansion. TSMC was not really in a hurry to set up in Arizona. Now they're on the hook for $65 billion of investment over the next few years. They are getting some of that in terms of incentives, $6.6 billion of incentives. But really, at the end of the day, TSMC has to become a geopolitical player, and that's really the challenge for them going forward.
A lot to digest there. Tim Colpin from Bloomberg Opinion walking us through the different elements of TSMC. We thank you so much for walking us through that. And of course, we're going to stick with the region. Coming up on the program, Fitch revises China's outlook to negative from stable, prompting criticism from Beijing. We're going to dive into the details next. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences but without losing the efficacy.
European stocks rising ahead of inflation day in America. Are the hot CPI numbers from the last 2 months a one-off? We're going to dive into that story. China pushes back against Fitch after it downgrades the nation's outlook from stable to negative, warning that the country is likely to pile on more debt. Plus, in the corporate space, the AI chip boom continues over at TSMC. Its quarterly revenues growing at their fastest pace in over a year. Good morning and welcome to The Pulse. I'm Kriti Gupta in London for our very own Francine Lacqua on holiday. Let's talk about the major story of today, which is likely to be U.S. CPI, the big data point that all economists and strategists alike are watching, really keeping an eye on whether or not the March report will show that those hot inflation readings of the past 2 months were an aberration as opposed to a trend. I want to dive into the details here. Bloomberg's Europe FX and rates editor Alina Oyamada joins me on the show. Alina, there's a lot of questions about whether 2 makes a trend or 3 makes a trend. The Fed loves to say it's data dependent. The markets have been shrugging off a lot of the data lately. Yet we've seen yields stay quite elevated. We're looking at, I think, 436 as I'm seeing it on my screen at the moment. Walk us through positioning here. What are the markets expecting? How could they react?
So the market is very bearish on treasuries over the past weeks because we had this huge repricing, this hawkish repricing toward pricing less cuts from the Fed this year. That comes off very strong data out of the U.S. So that's why today's CPI number is very important because it will help investors really assess if those other 2 figures were a bump or not. I think in terms of reaction, there's more room for a rally than a sell-off, simply because we are at this point that yields are at this year's highest levels. The market is already very short, so technically there's more room for a rally. But it all really depends on the data, of course.
Talk to us about the pricing there. The rate through the pricing, we've gone from 6, 7 rate cuts at the beginning of the year now to like 2. Yeah. What might change here?
I think we are at the moment where the market is divided between 2 or 3 rate cuts. The pricing is slightly favoring 2. So if we do get a softer print, we may see the pricing like going towards 3 rate cuts. I don't think it would go much further than that. That's also what the Fed has indicated. Whether there is room to price less than 2 rate cuts, I'm not really sure. Obviously, if a very hot print we get today, then we can always get to that point. But the talk so far has been between 2 and 3.
The bond story is interesting. A little bit of a snooze fest at the moment, given everyone's so positioned on the front end, as you pointed out. Let's talk about the FX market, because here's where I don't understand why the FX market is such a snooze fest. And it feels like it's because of the BOJ, but if you do start to see, say, the ECB or the BOE or name your central bank front run the Federal Reserve, we've already seen that from the Swiss National Bank, for example. Why is the FX market not paying attention? Why are they not more excited about that front running?
Yeah, I think you do see some action in specific pairs depending on how the expectations shift. So, for example, if you look at the pound, it was super strong at the start of the year because everyone expected the BOE to be more hawkish than the other central banks, and that has slightly changed, and then the pound is giving off its strength. For the euro as well, we are seeing some talk about parity because the ECB is expected to deliver more rate cuts than the Fed. And then for the BOJ, that's the biggest, I think, wild card there. The yen has been so weak, and the CPI could even send it through that line that we've been waiting for.
So, okay, we're talking about the U.S. lot. Let's bring it right back to Europe. Tomorrow's ECB day.
Yes.
You talked about this conversation of parity re-entering the narrative. What's the logic there? Is it just rate cuts, or is there something more to it?
It's basically rate cuts. To be fair, it's not a scenario that anyone has as a base case for the short term, but we saw how things can move quickly in that direction in 2022, right? So if we do get, for example, an extreme scenario, like Kashkari was saying, why do the U.S. need to cut rates?
Yeah.
If they don't, what if they don't? I think parity is really much in the game if that happens.
Yeah.
And we are seeing some banks exercising with that, bringing up that as alternative scenarios. So when you start to see talk about that, it kind of becomes more real, right?
It's a fascinating one, and one that we're going to see if it actually does translate over to the interest rate differentials that may or may not be driving the currency trade. Alina Oyamada, we've picked your brain plenty. We thank you so much for joining the program and walking us through that story. At the same time, we got to talk about the global growth picture. We talked about the U.S. We talked about Europe. Let's talk over to Asia as well. Fitch has revised China's outlook to negative from stable. The ratings agency saying that the government likely to pile on more debt onto its balance sheet as it seeks to pull the economy out of a real estate-driven slowdown. There's a lot to dive into. Let's bring in Bloomberg's Jill Desis to kind of walk us through it. Jill, pleasure to have you on the program. A property-driven slowdown. Connect the dots for us here. What is Fitch thinking?
Sure, Kriti. I guess ultimately what Fitch is telling us is not too much outside of what we already know. I mean, they're citing a lot of things that we know to be true about, the slowdown of the world's second largest economy, around the real estate crisis, and saying that as the slowdown continues, China is going to have to use more fiscal stimulus, more fiscal policies to kind of, try to help prop up the economy, and that may result in some additional debt risks. That's ultimately Fitch's argument for why they're changing this outlook here. I will point out that this is coming just a few months after Moody's actually made a downward revision to some of its concerns about China's outlook as well. That happened back in December, also citing some additional concerns around the economic slowdown, around China's fiscal position. So that's what's really tying all of this together, is that ultimately China's going to have to spend more to sort of help out its economy, and that may continue to create some additional debt risks for China right now.
What is China's response to that, though? I imagine they don't like anyone, regardless of who it is, saying this is uninvestable, this is a concern. How has China responded?
No, I mean, they've pushed back pretty strongly against this Fitch report. So it's actually, again, echoing what we saw China tell, in response to the Moody's downgrade back in December, is that they're saying that, their position is pretty solid. There's a lot good that's going on with the economy in terms of remaining stable. They're not really concerned about, these positions in the same way, and that ultimately, they're saying that China's actually been pretty responsible and stable when it comes to using fiscal policy to sort of help the economy. So I don't think any surprises from China there. I'd imagine that, any other global economy would do something fairly similar if you were faced with some kind of an outlook downgrade or worse from a credit ratings agency like this. So certainly some strong pushback from China there. We'll see how that ultimately, plays out. I will also say that among some analysts, they're saying, look, Fitch might actually have it a bit backwards here. It's actually a good thing if China boosts its fiscal policy in order to help the economy, because that just means more support, more spending to try to fix issues related to the property sector, related to domestic demand, which of course have been dogging China for quite a few years now.
When we're talking about the China story as well, there are geopolitics that we have to be very careful with as well. When we talk about from an investment playbook, there are headlines that came out this morning about Chinese President Xi Jinping meeting with Taiwan's former President Ma today. This was a meeting that was in the books for a while, but it is the first time that Taiwan's former president goes to Beijing. Talk to us about what we're looking for. Why now?
Sure, Kriti, I think there's a couple of things to keep in mind here. So first of all, this former Taiwan president, he's from the Kuomintang party in Taiwan, which is not currently the party that holds the presidency. It's actually more of the Beijing-friendly party. They lost in the most recent election in January to the DPP candidate. That's the candidate that favors more of that, independence from China. So this candidate is already fairly friendly with Xi. Has met with him before, or not candidate, but former president. He's met with Xi before, so this isn't, I guess, a massive surprise in terms of that kind of relation. The one thing that I find really interesting about this visit with Xi is that it's coming at the same time that the U.S. is in the middle of this days-long sort of state visit from the Japanese Prime Minister Kishida, along with this trilateral summit with the president of the Philippines. So wondering if there's any kind of a contrast there between the U.S. talking with some of its strategic defense partners, countries in region, in Japan, in the Philippines, within the South China Sea, versus China meeting with the former president of Taiwan. I think there's some sort of geopolitical considerations when it comes to the South China Sea that China might be trying to set up as a contrast here with this kind of meeting.
Certainly is one that we're going to be watching very, very closely, a historic moment nonetheless. Bloomberg's Jill Deeses, we thank you so much for joining the program and breaking it down for our international audience. Coming up on program, a Boeing employee says the plane maker took shortcuts to ease production bottlenecks for its 787 Dreamliner. We're going to bring you the details next. This is Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The conversations that matter and the insights you need. Welcome back to The Pulse. I'm Kriti Gupta in London. European defense stocks up slightly after falling heavily yesterday, their worst day in about almost 18 months. It comes after Goldman Sachs analysts warned that the sector's recent rally means that it's been left trading at elevated price valuations. Ollie Crook is in Berlin joining us this morning for a little bit more insight here. Ollie, classic technical trade here. Big sell-off yesterday, kind of a big move this morning. Walk us through what we need to know in terms of whether or not this is a sector people want to invest in.
Yeah, so Kriti, it's a sort of complex question. I mean, I think broadly speaking, the trend is intact, i.e. there's going to be a huge amount of money spent on European defense for many, many years to come. The question for investors is really how much. So you see clawing back some of those losses from yesterday. This morning, Saab is up, Rheinmetall up a bit. Still losing, though, on BAE. And Leonardo, but they slipped as much, some of them as 10% yesterday, which was really their biggest move to the downside in 18 months. Much of this pegged for many people to that Goldman note that came out that was really warning over valuations, looking primarily at price to earnings ratios that had gone at a sort of 45% premium to the stock 600, when historically this is a sector that's traded at a 7% discount, right? So a little bit of dislocation there. Maybe there isn't that much more room to run. All of that being said, we've got to put it into context. context, you look at Rheinmetall over the last 2 years. I mean, this is a stock that has gone up 450% over that period of time. You look at their PE ratio, Creedy, for Rheinmetall, you know, this German company, it's higher than Apple's right now. So it gives you sort of an idea of what markets are trying to do here and trying to figure out what this actually looks like going forward.
In terms of going forward, though, Ollie, there's a lot of questions about the ramp up in the defense sector broadly. Do you get the financing? Do you get the capacity? Do you even have the raw materials to do it? What's the biggest hurdle right now for some of these European defense companies to really match the size, for lack of a better term, of their American counterparts?
I think it's exactly that, Creedy. I think it's got to be the money, right? Will the dollars, will the euros match the rhetoric? This is the big question, because you hit on exactly the question that I think we're all asking ourselves and that we're going to need to figure out over the next couple of months is how do you actually pay for this? There are really only 4 ways that you can pay for this. You can either raise taxes, raise debt, cut budgets from elsewhere, or grow your way out of it. Europe has not been great at growing its way out of anything over the last couple of years. Raising taxes is raising taxes, always complicating. Cutting budgets from elsewhere, as we saw with the German government crisis, that is also very challenging. And then so it leaves this question of raising debt. And really the only way to do that, because you don't have the fiscal space in all of the countries of Europe to do this, would be the question of Eurobonds, joint debt. And this will be, again, in focus probably next week when the EU leaders meet once more. It's going to be a question that is really going to be plaguing us for a while now. The question is, how do you get that 2% spend in NATO? And do you need to go over 2%, potentially, if you have a President Donald Trump who's willing to step away from NATO? And this is really the big equation that markets are trying to solve and investors are faced with.
So that is the NATO story. You kind of hit on it there, but dive into it a little bit as well. In terms of the European elections and not just the American election, where do people stand? What's the biggest flashpoint on the continent?
Yeah, what I think is interesting on the question of defense is I think there is consensus, broadly speaking, that this needs to happen, that we are in a new paradigm. Everybody from, Germany, even Hungary, a lot of these countries agree that more needs to be done and spent on defense. So it's interesting that both the left and the right agree on this. The question is the financing question part of it, right? So the right is going to want to do more of the cutting from sort of social welfare and these sorts of things, whereas, on the left, they're going to favor probably this debt financing question. So it's all a conversation that is going to continue to accelerate going into the European elections. I mean, there's a degree to which there isn't a huge amount they can do other than sort of begin to build consensus among leaders. They're going to wait for the next session, June, after this election has gone by. But this is going to be a very live topic. And what's interesting also, Creedy, is that you're going to have to prioritize. We're talking about an energy transition. We're talking about raw materials. We're talking about all of these different sectors that Europe wants to win at. Military, unfortunately, for those who care perhaps more about the other things, is going to have to be #1 for many people because they're saying all of it is on the grounds of national security. Guns and ammunition really are national security.
Bloomberg's Oliver Crook bringing us that crucial story out of Berlin. We thank you so much for putting it into that crucial context. And I want to stick with the aerospace and defense theme here. The FAA over in the States investigating claims made by a Boeing employee who says the plane maker took shortcuts to ease production bottlenecks for its 787 Dreamliner. In a statement, Boeing said the claims were, quote, inaccurate and do not represent the comprehensive work being done to ensure the quality and long-term safety of the aircraft. Joining me now, Bloomberg's global editorial leader on aviation, Benedict Campbell, joins me right here on set. Boeing has had its fair share of troubles. The latest coming out of these whistleblower allegations, what were the allegations?
So the allegations broke last night. The whistleblower actually appeared on a conference call with reporters and with his lawyers, and he spoke about the 787. That's the larger of the 2 Boeing planes out there right now. We've talked a lot about the 737. That's the 737 MAX that had that issue at the start of the year, and that's really put the company in the public eye. This one is about the 787, the larger plane, and his allegation is that Boeing essentially took shortcuts and was essentially sloppy in the way that they put this plane together. There are big barrel sections where you have to sort of get these sections to fit together, and this is a very precise exercise, and Boeing didn't use the right precision to do this. They used brute force to put them together. I'm simplifying a little bit, but that is essentially what he's saying, that they didn't apply the right procedures and standards. They tried to rush these planes out because there was a big bottleneck, so they were trying to get these planes out faster than they should have.
Okay, so those are the allegations. We read the statement in terms of Boeing's response as well. In terms of next steps here, let's talk about leadership. What comes of Boeing? What kind of time frame are we looking at as the pressure ramps up?
So So the pressure is definitely on the company from many different areas. From the public side, a lot of people are now starting to wonder, what was previously seen as impossible, are starting to think, should I board this plane? Is it safe to fly? The kinds of questions people would previously never have asked themselves. There is pressure from the governmental and from the regulatory side. There is a hearing next week on the Capitol Hill that Boeing has been asked to attend. That'll be a big question whether Dave Calhoun, the CEO, will actually go there or whether he will sit it out and just hand in written comments. It all depends on the kind of look they want to portray. Calhoun has resigned, or he is, he said he will step down. He's still in the post, but for all intents and purposes, he's gone. They're looking for a successor. He says he might stick around until the end of the year, but I will bet that the moment they have someone, and they will probably fast track this, they will try and get him out of the door and that new person in, because there are so many issues the person needs to work through.
What is the ripple effects here in terms of the read-through? You mentioned this in our last program. This is a duopoly at the end of the day, Boeing, Airbus, et cetera. There are already capacity issues, backlog issues, not to mention raw materials, and airfares only getting more and more expensive. So the demand seems to be almost insatiable. What happens next?
Well, that's a huge problem, really, for the wider industry. So, Boeing and Airbus are the two premier manufacturers of these planes. And the moment there is one issue on one side, it ripples, as you say, through the entire industry. We've had companies like Ryanair, Michael O'Leary, the CEO there, say, we're not getting the planes that we need. This is peak travel season. The rush has come back after the pandemic. People want to fly, and they're not getting the planes they need. They've had to take out some capacity already. So that is one of the big problems they're facing. And that means that used planes, older planes, are being flown longer, are being flown more extensively. That means more maintenance. So a lot of these ripple effects playing through and ultimately landing with people like you and I, with a consumer, and more expensive tickets for planes.
Yeah, it's certainly an evolving and potentially disastrous, even further so, situation. Bloomberg's global editorial leader on aviation, Benedict Campbell, walking us through the ramifications of the latest with Boeing. Coming up on the program, we go back to geopolitics. South Africa and the European Union failed to host a bilateral summit last year. We'll discuss the state of relations next. This is Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
Conversations that matter and the insights you need. This is The Pulse. I'm Kriti Gupta in London. South Africa and the European Union say they are working on plans for a bilateral summit. It comes after Bloomberg reported plans to hold a gathering last year that had been thwarted, with South Africa failing to commit to a date. For more on the story, joining me now, Bloomberg's Jennifer Sabasaja reporting on it. Jen, walk us through the current concerns here.
Yeah, Kriti, I mean, the concerns really center around the current trade relationship between South Africa and the European Union. And we should mention, of course, the European Union is South Africa's biggest trade partner, also its biggest foreign investor. So it's very significant. But that is why a lot of people are wondering, why then have we not seen these annual summits that have been happening? So just to give you a little bit of context, there was an agreement that the two blocs signed back in 2004, which established preferential trade agreements, but also regular political dialogues. And we saw a number of these summits happen between 2009 and 2013. But according to some reporting based on our Bloomberg's Anthony Squizine, many people are saying the reason why we haven't seen a summit, and especially in 2023, is because South Africa couldn't commit to a date. And I think the concern is also that we have to take a look at what happened in 2023. South Africa was conducting naval exercises with Russia and with China, also was accused by a U.S. ambassador to South Africa for potentially supplying arms to Russia. And so the question is, have we not seen these summits because South Africa is potentially moving away from the West? Yeah. But we did get some response, though, from both sides on this.
All right, Jen, so that's the European Union story. In about 30 seconds, I'm putting you on the spot. I want to turn to South African politics. ANC support plunging, according to the latest poll. How bad is it?
I mean, this is significant, Kriti, because the ANC, of course, has been in power since the end of apartheid. And this latest report shows that the ANC may garner just 37% of support. And this is significant because we've been talking about the ANC potentially retaining this majority. And if they are not able to do so, then what does the government actually look like? And the real twist in this story here is that they've been losing support to a party backed by former President Jacob Zuma, which is the MK party. And so as we approach May 29th, we're going to continue watching to see just what potential coalitions look like if the ANC does not get this majority.
Certainly one we're going to keep an eye on. Of course, seeing a little bit of volatility in the South African ZAR as well. Bloomberg's Jennifer Sabasaja, we thank you so much. Up next, Bloomberg brave Danny Berger, Manus Craney, walking you through the stories you need to know going into the New York trading day. This is Bloomberg.
Been so used to the fact that every time there's a problem,
central banks come and ease. This has been the kind of playbook, you know, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted, and I think many people, even in the markets, have not quite understood, in my mind, how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Good morning from our world headquarters in New York. I'm Manus Cranning.
And I'm Danny Berger. Welcome to Bloomberg Brief. Set your agenda.
It is CPI countdown. The U.S. inflation report is just hours away. Investors are positioning for the latest clues in the Fed policy path.
Fitch gives China a negative credit outlook, saying the country is likely to pile on more debt.
And Boeing's latest battle. A whistleblower makes allegations of shortcuts in the production of the 787. Boeing disputes these allegations. Are you nervous for CPI?
I'm excited for CPI. Nervous? Get out of here. I'm ready for it, man.
Get out of here. Well, look, it can either fill or kill these bonds, that's for sure. Have a look at the bond market, because if it prints 0.3%, is that enough of a trigger? In other words, a drop back in the core CPI. Is that enough of a trigger to cause bond yields to drop? I've just got off the IB, and the feeling out there in the market is this. Today will be pivotal. It'll either, we're at 60% for a June cut. We're either going to move to 40% for a June cut or 80% for a June cut, because we're going to count down to the PCE in April. So crude is up by a third of 1%. Again, there is a sense out there in the oil market. We've broken 2 days of losses, even though the stockpiles have expanded by over 3 million barrels. The news line from Iran, the Iran Revolutionary Guard, says it won't block the Hormuz Strait. This is critically important when it comes to the flow of oil. JP Morgan are reinvigorating their $90 call and $100 by the end of the year. Bitcoin comes back by 0.25%. The halving is already in the price. That is according to the Marathon CEO. We just dipped back ever so slightly. Danny, good morning.
Good morning, Manus. And some of those nerves, some of that hesitation, the quietness in the market over the CPI, you're not really seeing the same in equities. It hasn't scared buyers yet. We had a late in the day rally yesterday. That's continuing through to this morning, up about 0.2% for both S&P and NASDAQ futures. Manus, this is my fun fact of the day for you, because we have been moving sideways. We have gone 7 consecutive sessions now without a new record. To give you an idea of just how crazy it was to start the year, that's the longest period without an all-time high since January. That fun fact comes courtesy of Henry Allen over at Deutsche Bank. Meanwhile, NASDAQ is outperforming, perhaps thanks to TSMC's strongest sales since 2022. Europe outperforms, picking up some of the rally of yesterday. yesterday in the U.S. equity session, up about 0.6%. But Manus, it is, of course, CPI that will make a difference for these equity markets. JP Morgan says that if it comes in softer, hold on, because we'll be getting a big risk rally.
Well, hold on. I mean, nobody's as stoic as you. The point about it is whether core inflation comes in at 0.3%, does that make the January and the February readings the temporary bumps, as we've been told by the Fed? Positioning into this, and that is the critical part. You've got Bostic, of course, talking about extending maybe out to December, and indeed reaffirming. I mean, he is the bear. He's reaffirming that it may only be one cut for 2024, and that could be extended right to the back end of the year. I don't think this bond market is ready for either of those facets.
But it has been moving more towards this idea that we're going to get a hot surprise, which would be the third consecutive one. And if we don't get that, though, the market does feel primed for a short squeeze. I have a chart, Manus. It's the JP Morgan Treasury Sentiment Index. This is of their client positionings. It is neutral for the first time in about a year. In other words, we're moving away from long positioning and shorts are starting to rise.
Okay, well, let's take that. And, of course, the commentary from the Atlanta Fed President, Raphael Bostic, stating this. He's open to changing his view of one rate cut this year, saying, I can't take off the possibility that the rate cuts may even have to move further out, but if there are signs of pain in the jobs market, then I'd be open to changing our policy stance and perhaps cutting sooner. Let's bring in our guest. It is Ella Huja. She is head of fixed income at Newton Investment Management. We'll come back to Bostic in just a moment, but let's deal with the positioning in this market. If we get a 0.3% reading on this core inflation today, could that be enough of itself to stop the sell-off in this bond market? Ella, good morning.
Good morning. I would say because the investors are probably quite nervous into the numbers, so there's some hedging that's been going on, and as you showed from the JP Morgan positioning survey, a lot of the longs have come off, so perhaps in line to slightly softer would be good enough for risk markets and certainly support the bond market temporarily. But the truth remains that data is strong, right, on services, on the core components, and the economy is still running at a decent momentum. And so basically, you still have a good amount of cuts still priced in the year ahead for the Fed. And so there's still some more damage that we can do, given that we are starting to shift away from the more benign base effects on inflation. So from this month onwards, base effects start to wear out. So the risks are still there, I would say. So perhaps we might get a temporary respite, but down the road, I don't think a lot would shift. It's just more a case of can the Fed deliver sooner on those cuts.
Does that mean that there's nowhere in this treasury market to buy, Ella, if the risks are still there?
We have been in favor of the steepener trade, absolutely, and I think you have a bit more protection in the short end of the curve. I think that sort of bias where they're keen to cut still, or at least deliver at least 2 cuts this year, would support shorter dated maturities, would support some of the credit markets. It's just a case of what happens out in the curve. So I think with this backdrop and a Fed that hasn't fully shifted away from its more dovish stance, then I think you probably is safer staying in the shorter maturity bucket rather than out in the curve.
What are 2 rate cuts, or even if Bostic, the risk is this, we seem to be fighting the tide in terms of rate cuts. I just wondered to what extent is the bond market prepared for 1 cut and it to come as late as December?
Well, I would say probably better prepared than it was in January, right? So we came into January with a huge positioning and obviously on the back of a big rally from December. So there's still more momentum to go. I would say, technically speaking, the pressure is still for higher yields, right? So if you look at the way we're trading, we're sort of making higher lows in terms of ranges. And so the risk is still higher, and we have been more cautious with that view in mind. So you can do more damage. But of course, I think bonds would be a little more sensitive to growth data, and we've just not had enough of that coming out of the U.S. So for now, I think the momentum remains for yields potentially higher.
Ella, one of the most read stories on the terminal this morning is about CPI, but it's more CPI adjacent. It's this idea that there was a worker at the BLS who had this group that he at least labeled in his email as super users, the likes of BlackRock, JP Morgan, some hedge funds, some research firms, basically corresponding with them, helping them out with the data. But the BLS has come under scrutiny for this, themselves saying it's an embarrassment. We've talked a lot about this idea that the data is not extremely as extremely reliable as one would hope. What does it mean as someone who's trying to interpret this data, trying to use it into their investment strategy, when you have a knock of reputation to the BLS, to the very agency putting out the data?
Well, I'm definitely not on the recipient list, I can say, of that information. But no, I mean, I think information asymmetry is a problem, but it's existent in markets. I don't think that's any news. You know, there's always additional color that's sought from additional analysis. So potentially a little bit of an embarrassing story. But I guess it's very difficult to do our job with just one piece of information, I suppose. We're always looking for a mosaic of pieces of information. And so I'm sure this too shall pass, if I may say.
Well, it's certainly one of the most read stories, but then for time immemorial, there's been privileged access when Fed and various officials turn up at various events. It's about insight and access. Ella, the commodity shift that we have seen in gold and a number of other commodities, you say that tells you something not so much about inflation hedging, but about real rates.
Yes, I think, you know, it's a school of thought. Obviously, it's an opinion. That's what makes the market. But I guess one of the triggers potentially it's signaling is that the anticipation in the market is either that this central bank will cut or will ease into potentially an accelerating cycle, especially on the inflationary side. And so you're buying some protection to that. Or that the end game is eventually that real rates need to be suppressed significantly because we just cannot withstand rates that are substantially higher for longer. And I think that's, you know, commodities and particularly gold offer you a way of hedging some of that risk. So it does make sense. It's not irrational to assume that.
So when it comes to the Fed versus the rest of the central banks, Pictet and Jupiter figure that the market is being too sanguine on what the BOE is going to do. They say that there is a risk that the BOE goes faster and cuts more deeply than the Fed, and the market is underappreciating that. They say versus the Fed and the ECB, and therefore gilts look attractive. Is that a trade you'd want to put on, Ella?
Yes, we've been actually running a long in gilts position, and it's exactly for the same reason. We're a little bit less constructive on the European bond side, and that's because we think enough cuts are priced in, and it's very negative carry to run longs in bonds. We believe they're actually rich. But in the case of the UK, that's true. We have sort of taken profits on half of that position, I might say, predominantly because that ran quite a while. So from here, I think you need to be a bit more cautious, but still, structurally speaking, there's a bit more weakness in the UK consumer story, who gets hit both from higher mortgage rates and certainly this bite that comes through the cost of living crisis, which has ameliorated but still remains a pressure point for the UK consumer.
How important or how revealing will the minutes be today for the Fed?
I think they're essential in the sense they'll give us more of a sense if we're shifting from this center, which was very much about wanting to go with the Taylor rule, so deliver those cuts that the Taylor rule was suggesting. So we'll get a sense if there's a bit of a wobble around that. My view as a bond investor is there should be a bit of a wobble because we've had incremental pieces of information that tell you they should be backing away a little bit here. But my read of the Fed is they're very keen to cut, right? And so as we have learned the lesson in the market, don't go, you know, don't fight the central banks, but there are some times when you have to, right? So you know, it remains to be seen, but my read of them is they are very keen to cut. So they'll latch on a sort of a fairly benign CPI print to do just that, right? Because of course we have elections coming up in November, so you don't want to steer too close to the elections. But at the end of the day, let's see what the minutes tell us. Let's see what inflation tells us. But certainly the direction of travel seems to be a little bit more in the be careful camp, I would argue.
Yeah. I know you say don't fight the Fed, but Ella, we know you have a little bit of that bond vigilante streak in you. Ella, thank you so much for joining us this morning. Ella Hoja of Newton Investment Management. Okay, Manus, let's get to some of the other top stories that are trending on the terminal this morning. Intel is rolling out a new version of its AI chip. It's aimed to challenge NVIDIA. The updated processor called Gaudi 3 will be widely available in the third quarter. The chip is designed to boost performance in two key areas, helping train AI systems and running the finished software.
At least 3 people were killed after an explosion at the Enel hydro power plant in northern Italy. The explosion occurred as maintenance work to renew the facility's at the 1970s era plant work concluding. Prosecutors say they will open an investigation into the responsibility for the accident, with a possible focus on the contractors hired for the renewal of the plant's turbines.
U.S. Ambassador to Japan, Rahm Emanuel, says the Biden administration is looking to reverse China's attempts to isolate countries in Asia with help from Japan and other allies. Emanuel spoke to Bloomberg in Washington ahead of a summit between Biden and Japan's prime minister.
China's whole strategy is to isolate the Philippines, isolate Australia with their economic origin, isolate Japan by not accepting their fish to be exported. Our strategy is to flip that script and make the isolated party China. They're the ones that are isolated in the South China Sea as it relates to the Philippines. They're the ones that are isolated when it comes to trying to use economic coercion to coerce Australia to change their posture. And they become the isolated party, which is why they throw in the towel on that effort.
Coming up this hour, negative outlook for China from Fitch Ratings. We discuss the details.
But first, up next, shares of Boeing hitting the lowest level in 5 months. The company faces a deepening crisis. More on that next, here on Bloomberg Brief.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Season is coming.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead just coming out right now.
We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been?
Better than what the street was expecting. Bang in line with estimates.
We will have full and instant analysis.
It all starts Friday on Bloomberg. Context changes everything.
It's Bloomberg Brief with Danny Berger and Manish Kranny in New York. So shares of Boeing, Manish, they fell to their lowest level since October after an engineer at the plane maker alleged that it took shortcuts in manufacturing 787 Dreamliners. The whistleblower says on a conference call that, quote, in a mad rush to reduce the backlog of the planes and get them to market, Boeing did not follow on its own engineering requirements. Now, Boeing, for its part, has rejected the allegations, saying that the claims are, quote, inaccurate. Bloomberg's Benedict Campbell joins us now for more on this. I mean, Benny, this was a whole production. It was a whistleblower with a lawyer, a news press conference, and pretty damning claims, again, which Boeing has disputed. about the Dreamliner. What exactly were those claims?
So these claims came out last night. We were on a conference call with other reporters and with the lawyers and the whistleblower, who interestingly remains an employee at Boeing. This is somebody who's worked on the 787 Dreamliner program. Just to give people some context of the plane, we've talked a lot in the last couple of months about the 737. That's the smaller, narrow-body aircraft that had that incident at the start of the year. This is the larger plane, the 787, that's used for long-distance travel, and it's built in a slightly different way because it's made of composite materials. You have these big sort of barrel sections that need to be pieced together, and there will be small imperfections in the way that these pieces are put together, and engineers then have to look at these and need to make fixes. It's called shimming, and the allegation now is that they didn't follow this process properly. They cut corners, they were sloppy, they tried to rush these planes out because these small fixes are fairly complicated and time-consuming, and that was time that the allegation goes Boeing didn't want to spend and therefore rushed the planes out, and that might, over time, compromise the structural integrity of the aircraft.
Yeah, I think the language used was wrongly measured, filled gaps. They were in a mad rush to reduce the backlog of planes. How can Boeing regain any upper hand narrative in this? They can defend the processes, they can defend the allegations. They are in some kind of literally a vortex of bad news and reputational injury at the moment. How do they change that narrative?
Well, you're absolutely right. They're in a real funk at the moment, and this started around that accident that I talked about at the start of the year, and it's just getting progressively worse. With this, they are furiously pushing back on these allegations, saying this is wrong. We have fixes in place. They don't dispute that the 787 did, for some years, have some manufacturing issues, but they say that we went to great lengths to fix these. We put processes in place. We haven't put sort of profit over process and speed over safety. But that is very much the allegation and the public concern that sticks. So they have to change that narrative. How do you do that? Probably with a new CEO, Dave Calhoun, who remains in place at the moment, but is essentially on his way out. He will have to make way for somebody new, and that person really needs to reset the tone of the company, and they need to regain the upper hand of the narrative, put engineering excellence first, put manufacturing first, put the products first, forget about finances, forget about making money, as hard as that might seem, but that really is where they need to go, because as long as you'll have people in the public wondering, do I want to board this aircraft, looking at what kind of plane it is they're on, that's as long as that problem won't go away.
It is allegation after allegation for Boeing. It is difficulty in their earnings. It keeps stacking up. I mean, does this not light a fire under them of we need a new CEO and we need it now?
You're absolutely right. They do need that person sooner rather than later. Calhoun has said he will stick around until the end of the year if needed. I would bet that he will leave far sooner than that because the problems are so vast and the challenges are so big. They need that new person now. There's no obvious name out there right now, but I'm sure the board is furiously looking for that candidate. And the moment that person is named, Calhoun will step aside, and that person will have a huge task on their hands. But it's also, if they can turn this around, this is the big turnaround story in the corporate world right now. If you can get this right, then you're in the sort of pantheon of great CEOs. So massive challenge, massive millstone, dare I say. But again, if you're up for that, this is the job you want.
Okay, well, they're certainly up against it, and the debate is now going to be whether Calhoun can make it to the end of the year, because confidence is everything, and that's sadly lacking at the moment, despite the denials. Benny, thank you very much. Benny Camel there on the very latest Boeing woes right here on Bloomberg. Good morning from New York.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg Brief. I'm Manus Cranny alongside Danny Berger in New York. Now, ByteDance, it's the name of a company that invokes spirited response on Capitol Hill. But of course, its profits have jumped by 60%. It's taking a bite, excuse the pun, taking a bite out of Tencent and Alibaba. I mean, this is a ferocious move higher by ByteDance, the owner of TikTok, for anybody in the world that does not know.
Not only has it taken a bite, Manus, it is dancing.
You like that, didn't you?
It is dancing on Tencent.
Oh,
if I can paint the puns even more, it's the first time they've overtaken Tencent in terms of revenue and profit. It just shows the behemoth that ByteDance and TikTok have become. And for Steve Mnuchin and those who are hoping that Congress tells them you need to divest your U.S. asset, I mean, they want to get their hands on this thing.
Yeah, I mean, who are the investors? Have they got the capital? Will ByteDance split off the U.S. business? Will they give the intellectual data across? ByteDance also cut hundreds of jobs last year. I mean, they're not all of tech was under a bit of pressure last year, but they cut hundreds of jobs in their gaming division, in the enterprise software divisions as well. So they've already front-run some of that job-cutting narrative in the tech space as well.
Yeah, and for what it's worth for everyday people to get their hands on this, I mean, that long-awaited IPO keeps getting delayed, concerns about,
it's worth a lot less now.
Yeah, but I mean, people would still, I think, jump on that IPO, I am sure, but will come to fruition.
Danny's big on TikTok, so am I.
We try our best.
We'll talk more about the CPI in just a moment.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a three as the economic picture covering the intersections of Hollywood, Silicon Valley, and beyond.
Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger. Here's what you need to know.
We are on CPI countdown. The U.S. inflation report is just hours away. Investors position for the latest clues on the Fed's policy path.
Fitch gives China a negative credit outlook, saying the country is likely to pile on more debt.
And Boeing's latest battle. A whistleblower makes allegations of shortcuts in production of the 787. Boeing disputes these allegations.
So, Manus, the longs are getting wiped out of this market ahead of the CPI, but do you think the stock market cares?
Nah.
Nah. The bulls...
It's immune.
Yeah, the bulls are bullish as always. I mean, we are up only ever so slightly. It is worth mentioning, even though stocks have held up while we've seen wobbles at least underlying this bond market, we've been moving basically sideways. We do that again this morning. S&P up just 0.1% after that late in the day rally yesterday. NASDAQ futures, those move up by about 0.1%. A bit of outperformance, perhaps helped by TSMC. Really strong earnings. The American ADRs up about 1% or so. There you go on your screen. They're up 1% this morning. But we are in this moment where we haven't set a new record for the past 7 straight days. According to Deutsche Bank, that's the longest streak we've seen without a new record since January. So the momentum of this market has certainly cooled down. European equities up 0.6%, Manus.
Well, they're nervous in the bond market, that's for sure. We're going to see what this CPI print is. We're expecting plus 0.3%. That will be a slowdown from the bumps and the anomalies of January and February. Right now, 435 is where we are on the bond market. Bostic wants full optionality. He talks about the possibility of one cut pushing it into the last quarter, a robust U.S. economy. There was a massive option trade that went through, the biggest options trade ever in the history of options at the short end of the curve, 75,000 block trade. We are assuming that it was a buyer of that at the long end. We've got some more auctions coming through today. The 3-year auction, they had to cheapen that up yesterday to get it away. $39 billion worth of 10-year paper coming today. Crude is up by 0.25%. We're breaking 2 days of losses. The news flow from Iran, by the way, the Iran Revolutionary Guard says it won't block the Hormuz Strait. That's important. Golnar Motovali breaking that news flow down from Iran yesterday. JP Morgan has $90 on the table for crude by May of this year and $100 by the end of the year. Bitcoin slips by 0.1%. It's hardly a huge move. The sentiment is that the halving is already, that halving event, halving the amount of Bitcoin that will be available is already in the price. Danny.
And another question of what's in the price is hotter inflation in the price? We were just speaking to Ella Hoya of Newton Investment saying that, sure, you could get temporary respite if the CPI comes in softer with a bond market rally, but to her, that is not going to last. That ultimately, the pressure for this bond market is yields higher.
She did say more damage to come in this market, and that the pressure, as you say, it's going to come down to, and this is what we're going to discuss in just a moment, the elements of supercore. In other words, those rent elements, used cars, what is going to go on in that rental market? That is going to define whether January and February were an aberration, and whether we're returning to some kind of more normalized disinflation narrative.
Well, Powell himself said in the last conference, it is too soon to say whether the recent readings represent more than just a bump. So is today more than just a bump? And investors are bracing for that data. Manis, to be specific of what we're expecting, forecasters are expecting some moderation following elevated inflation readings to start the year. Joining us now to get all into this, it's Elena Shulyetayeva, senior U.S. economist at BNP Paribas. Elena, I was saying to you during the break that I've had it seems like a flood of notes in my inbox saying that 0.3% consensus is too much. Bank of America just had a note out saying they think it's around 0.2, a little bit stronger than that. So where is my tail this morning? Is it inflation that comes in stronger or weaker versus expectations?
We're at 0.3% on core, but there are reasons to believe it could be higher, it could be lower. So I think, if you look at core goods prices, we may see some decline there from used car prices. But there are reasons to believe that January and February was an aberration because, if you look at services ISM index, for example, that went up sharply in January for prices paid, and then that went down. So it looks like there could be some aberration in January, and that means inflation is decelerating into the spring months. But we could see some risks from shelter inflation. That's an upside risks. There's been a constant tug of war between supply and demand in the housing market, and housing prices are still very high. That is putting an upward pressure. So this morning, we're going to see 0.3% in our view. There are reasons to believe the risks are to both sides.
There seems to be a growing acceptance of slightly higher bandwidths of inflation will be tolerated and still allow the Fed to cut. Is that a narrative that you subscribe to?
I don't think so. They still believe in the 2% inflation target, I think. But you're right.
But there's a heck of a distance to go between believing in 2% with a core inflation way, PCE way ahead of where that target is. If we're going to go off core PCE, they won't be cutting this year.
I would answer with a question. Would you, if you were Chair Powell, would you really bang on the table and say 2%, 2% if you see the economy is doing great and you don't really want to really damage it, right? So if, say, we are getting closer to 2%, but not there, I think they will be a little bit softer on that.
This fun. I want to game this out of what would happen if Manis occupied the body of Chairman Jay Powell. He'd wreak havoc. Jay Powell shows up with an Irish accent, mass confusion everywhere. That'd be great. So, Elena, we also, it's sort of in this idea of optionality. We heard from Bostic, he was speaking to Yahoo yesterday, and he kind of said everything someone could possibly say. He said, I can't take off the possibility that rate cuts may even have to move further out, but if there are signs of pain in the job market, then I'd be open to changing our stance and perhaps cutting sooner. To me, that sounds like we could literally do anything. We could hold, we could cut, we could hang around.
Totally data dependent.
Yes.
And this is what has been the narrative recently from everybody. Yet it looks like, it feels like from the recent Fed speak that they are ready to start that cutting cycle. We don't necessarily call it an easing cycle, but they just want to get things going to make sure that the real Fed funds rate doesn't rise further and really they over-tighten policy too much. So there are some parallels to the mid-90s there. So Chairman Greenspan saw this big productivity boom and growth really being strong without additional inflationary pressures. So we are a little bit in the same boat right now. But right now it seems to be driven by labor supply more than productivity. But still, we can have strong growth, strong labor market, and some deceleration in inflationary pressures. So that means the Fed may start cutting rates. They don't have to go at each and every meeting or each and every quarter. They can start, pause. That's what happened in the 90s.
Bostic talks about a robust and strong and resilient U.S. economy. And with that in mind, do you see 2 rate cuts as being ensures the Goldilocks scenario and the nice soft landing of this economy, but then cast forward into 2025? Who knows where we're going to be in a couple of months. But this cycle of cuts, if you believe you've got a higher neutral rate, the cycle of this cuts, the scale of cuts in this cycle will be much less than a traditional cutting cycle.
Totally. I think we are at 3 cuts. This is our official projection, but I think it's obviously less than they would do in a recession type scenario. This is an adjustment cycle, cutting cycle. So, and this is what the Fed has in mind. As the economy is still growing, they just don't want to overdo it. They just want to adjust the level of rates so that they achieve soft landing.
Yeah. Well, speaking of this idea of insurance that Manus was kind of hinting at, we're going to get FOMC minutes today. I know you noted that the important thing for there is any details about QT. Is that something that also needs to be sped up? Well, not sped up, wound down, QT, but having that done sooner because of this idea that, sure, we're not seeing market stress now, but we need that insurance should it start to crop up?
Well, they want to start QT tapering so that they get it on the way and prolong that QT tapering cycle. And again, right, to alleviate any funding pressures and things like that. So our projection is that they will announce the details sometime in May and start Q tapering process in June. In terms of the minutes, in terms of the rates policy too, I think it's important to watch how many, and we're going to count those many and several and some words in there.
So hopefully you have an AI bot to do that for you, Yelena.
So how many of them are feeling that they need to move to a higher rate in terms of the SEP projections? Because yes, the median is at 3 rate cuts, but there are a lot of people above that, and we just want to get a sense of how that is going. And also, I would like to see if there's a very broad support for supply side of the economy drivers. So we heard that from the chair. We heard from other Fed policy speakers that the economy is really supported by immigration, by population growth, participation. Is there broad support for that type of narrative in the minutes?
Do you think this bond market, Danny had a great chart at the start of the show talking about the neutrality, the overall neutrality, the JP Morgan survey, overall neutrality. There has been incremental adding of shorts into this number. Do you think that there's more damage, to quote Ella from a little bit earlier, that there could be potentially more damage on the upside in yields if it's an at-the-money inflation print of 0.3% today?
I think 0.3 inflation print will be good for everybody. That would just mean that the Fed will, do what they are intending to do. And at the end of the day, that would tell me that it is really getting to a soft landing scenario.
Okay. Goldilocks will be happy. The porridge will be grand. Yelena, thank you so much for being with Danny and I this morning. That is our guest. Ahead of the CPI, Yelena Shutleva at BNP Paribas. Coming up in the show, negative outlook for China, this time from Fitch Ratings. We'll explain the details behind the cut.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words and then you put a few sentences together, and one day, you might be able to write poetry.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It is Bloomberg Brief. I'm Menace Cranny alongside Danny Berger in New York. So Fitch has revised the China outlook to negative, citing the nation's debt burden. This as it seeks to pull itself out of economic slowdown. Now, this comes as a similar move from Moody's in December. The Chinese government pushed back on the downgrade, saying this, that it failed to reflect the role of fiscal policy in shoring up growth. Alan Wan is with us from Shanghai. Alan, why did Fitch take the action now?
Yeah, I mean, that's a really good question. I mean, it was just a matter of time. Like you mentioned, Moody's did the same thing back in December, and things haven't really changed a whole lot. I mean, the property slowdown is going to hurt the Chinese economy, which in turn is going to force the Chinese government to increase fiscal spending, which of course was going to blow up debt. If anything, the timing is a little bit unusual just because you know, it looks like things are starting to turn up, improve in the Chinese economy. There's some anecdotal evidence. Stock market is starting to bounce back. And we've got a bunch of economic data coming up next week, such as first quarter growth. That's probably going to show things possibly improving from where they were some months ago.
Alan, presumably all of this is just priced in. I mean, this is not exactly new information, as you put it, that China is taking on a lot of debt. Yeah, I mean, that's right. But the reality, too, is that, you know, and the government said it as such, that the rating agency is not really considering the fact that by taking these actions, it's going to shore up the economy, and that's going to stabilize China's debt burdens. And China's debt burdens, I mean, how bad are they? It was 80% of GDP last year, middle of last year, which seems high, and it's high compared to where it was a decade ago. But it's lower than like other advanced economies like the U.S. and Japan.
Well, debt is certainly a hot topic in this country as well. So there's no irony lost on anybody in this debate. Tell me this, Alan. President Xi, he's got a meeting with the president of Taiwan. What's the upside? What are they looking for from this meeting? What does Xi want to achieve?
Well, you know, I think it's a lot of symbolism, a lot of peace symbolism. I mean, you have to understand what's going on right now, right? In Washington, the U.S., Philippines, and Japan are going to meet to discuss their concerns about China's growing assertiveness. Next month, you've got a new administration in Taiwan. Their leader has been called a separatist from some Chinese officials. So I think that it's more optics domestically, just to show that China is capable of talking to its counterparts in Taiwan, but not necessarily this particular administration.
Okay, Alan, thank you very much. That is Bloomberg's Alan Wan in Shanghai. Now, speaking of Taiwan, TSMC's sales grew at its fastest pace in more than a year, all thanks to, you guessed it, the boom of AI development. They're, of course, the world's most valuable chip maker, and they may now return to solid growth this year. Joining us now is Bloomberg opinion columnist Tim Colpan. Tim, I mean, these are some pretty nice chunky numbers for TSMC.
Yeah, especially you consider that they had a decrease in revenue last year. So first quarter numbers, double-digit percentage growth for the first quarter already. They're looking, they've already forecast that they will have solid growth this year. So this augurs well for a very solid year ahead. And as you say, it's all about AI, NVIDIA, AMD, even Intel are putting in a lot of energy to create new AI chips. And they're sending those designs here to Taiwan, to TSMC to make them for them.
Their AI revenue is growing at 50% annually. There you go. That's all the bots needed to see. There's the ADR up 110%. Tell me this. We've talked about the incentives, the loans, and perhaps the incentives the Biden administration are about to give TSMC to build factories here in the USA.
Yeah, well, they're getting as much as $6.6 billion in incentives from the federal government, which sounds nice, and I'm sure TSMC is happy to have it, but they are committing $65 billion. So TSMC would actually probably like to see a lot more than 6.6 billion as kind of a payback or a kickback or an incentive from the US government. There is actually some tax incentives as well that need to be calculated, which could add a few more billion onto that. But, you know, it really is a drop in the ocean compared to the amount of money they're spending in the US. And remembering that the US is a much, much higher cost base for TSMC to operate than Taiwan. So when they do get going and they do make chips, they're going to be a lot more expensive than they can make in Taiwan.
Huh. Okay, that's interesting. So in terms of other sort of following the production line type stories, we have these numbers from Apple, that their output from India has hit $14 billion. And Tim, I guess the reason that this is significant is it's just another notch in this narrative of Apple moving away from China and into India.
Yeah, I mean, it's so easy to fall into the trap that India is the next China. Of course, it's not, but there is quite a few similarities. And one of them is the fact that India is taking up a lot more of the electronics manufacturing. Companies like Foxconn, Wistron, Pegatron, and many more are expanding in India to make devices for companies like Apple. So we're going to see that number grow year over year for the next many, many years. The key for Apple and many other companies, though, is will India replace China in terms of consumption? China is a very big consumer of phones and all sorts of other electronic devices. India is growing, but you know the demographics of India are very different. So the challenge for companies like Apple will be to find new growth markets to buy their products, not just places to make them.
Yeah, well, it certainly comes off the back of Yellen's trip there, talking about all of the issues around domestic and international, let's say, supply and demand from China. Tim, thank you very much. Great context this morning on TSMC and Apple, our Bloomberg opinion columnist. Now, if you are out there and you've got your Rolex on, the question is, have you got the right Rolex on? Because we've got our Bloomberg subdial index flat for the year. Sorry, flat for the month, I should say, down 9% for the year and down 42% for the year. But not all Rolexes are created equal, are they, Danny?
I was going to say, look at your watch. If you've got the Rolex, that's the blue and the red, a.k.a. the Pepsi, or the one with the green bezel, a.k.a. the Starbucks, congratulations. There you go. There's the Pepsi. Congratulations. You have a watch that has gained in value. It's so hilarious to be talking about this because the CEO of Rolex, oh, by the way, this is the Batman. This one, I'm sorry, it is flat.
You like this?
This one, I like this one, but it has not gained in price. You pay more
for that?
Maybe, I don't know.
20,000, what is it, 20,000 bucks for the Pepsi, the regular Pepsi, $21,000 if we're being generous. But of course, if you got the Submariner, poor man's Rolex, is it?
Poor man's Rolex. If you got the Patek Philippe, which is probably the rich man's Rolex, that gained more than 1% to go at $98,753, Manus. I'll have one for Christmas. Thank you very much.
She'll have one for Christmas. There you go. If anybody's got a Patek 5711. By the way, you can go on Poshco at the moment. Just having a look. We've got a few Rolexes on there. A little bit of Gucci. We've got a Rolex GMT ceramic root beer. $17,250. I'll give you an ID later on.
But you know, we're not supposed to be talking about this. Remember the Rolex CEO, wasn't it just yesterday? He said,
do not equate these assets to stocks.
Yes, exactly. These are not stocks. They're not investments, which, again, I still don't understand because I think more people would buy watches if you say, hey, these might go up in value.
There's quite a few people have heavily invested in watches and have a reasonable exposure to these. And of course, to make your watches, you're going to need a little bit of commodities. One small portion of that is gold, which is careering through records. It comes back a little bit this morning, Danny. But of course, it is down to central bank buying. We know that.
Yes.
And a whole host of other moves in the commodities.
Yeah, exactly. We are looking at copper LME up about 0.7%. It is trading at the highest level in 2 years. Middle East tensions continue to simmer. Your NYMEX crude at $85 a barrel. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal. The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Wow.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
It's Bloomberg Brief, Danny Berger and Manish Cranny in New York. All right, let's get you set up for your trading day. Here's a look at what's ahead. It is a big day on the inflation front. CPI comes in about 2.5 hours, 8:30 a.m. Eastern. Then Chicago Fed President Austin Goolsbee will be delivering remarks at 12:45 p.m. Eastern. Then we get the FOMC minutes. Those will be released, of course, at their last meeting at 2 p.m. Eastern. Manis, it's about two things, just what the divide is on rates and at the same time what they're going to say about the pace of winding down QT.
Absolutely, and 0.3% on the core. What is the owner's equivalent rent? That is going to be the core part of the discussion. A little bit later on, we'll bring you through that here on Bloomberg. Some stocks to keep an eye on. Alphabet rises as Google unveils a host of updates on the AI side and at their annual cloud conference. Then you've got Trump Media down by nearly 2%. This is the co-founders are now challenging that 6-month lockup period and their ability to sell this stock, and they're claiming it's done irreparable harm to them. Tesla is up by 0.5%, reportedly in early discussions with Reliance about a possible JV to build a manufacturing facility in India. Danny.
All right, you got 2.5 hours, just a little bit more than that, to brace yourself. Go get that cup of coffee. Get yourself ready for CPI. 0.3% is the estimate for month over month.
the linear business is not going anywhere. The sports business is moving is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be, every single one of the players want to be in it because of the audience. We have two assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
This is Bloomberg.
We're in an economy that still has a lot of inflationary pressure.
I would not assume that inflation numbers would be super sticky, but they would certainly be bumpy.
We are still looking for disinflation to continue.
We're talking about inflation behaving, okay? We're not talking about inflation accelerating.
Inflation will be sticky. Inflation will be absolutely sticky, and I do think that actually warrants, over the long term, the Fed rethinking its inflation target.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City. Your week begins right now. Good morning for our audience worldwide. This is Bloomberg Surveillance alongside Lisa Abramowitz, together with Anne-Marie Hordern. I'm Jonathan Ferro. Your equity market has not really done much over the last couple of days. At around 8:30 Eastern, expected to do something. I think we have to begin this morning with the words of Chairman Powell. It's too soon to say whether the recent readings are more than just a bump. 8:30 Eastern time. Are we going to get another bump in the road?
And how much actually consists of a bump? That's actually one of the key questions. If it's in line, we've already heard this from numerous types of analysts saying an inline print is going to be basically a beat, and you probably will get a rally in markets. How big of an upside surprise do you need for this Federal Reserve to really reconsider the decision, not only to cut rates in June, but just more broadly to cut rates 3 times this year?
Let's go through the estimates. 0.3% month over month for core inflation is the estimate. The previous number, as you all know, was 0.4. When you go through the numbers, the predictions on Wall Street, very few people are looking for an upside surprise this morning.
That's right. You see some actually coming in with a little bit lower. But I go to Stephen Stanley at Santander overnight, putting out this note, talking about the number of analysts, what he's seeing is trying to spin tomorrow's results. This idea, and Lisa, you said this yesterday, are expectations basically a beat. But when he looks at that at a 0.3% rise month over month, that ends up being annually 3.6%. And he said it is highly unlikely for anyone at the Fed for that number to satisfy them.
When you talk about expectations, let's talk about market positioning. The bearish bets on treasuries absolutely skyrocketing ahead of this report, which basically sets the market up for a massive short squeeze if we get anything other than a huge upside beat. This is important. You talk about market expectations. How big does that upside surprise have to be to fulfill all of these bearish bets of people expecting some runaway inflation? And if we don't get that, could you get a monster rally in bonds and a monster rally in stocks?
Pair those bearish bets on treasuries with those bullish bets on energy right now. Just listen to this. Lori Calvasina, RBC, sticking with energy. Morgan Stanley's Mike Wilson, overweight energy. Marko Kolanovic over at JP Morgan, guess what? Stay overweight commodities. That has quickly become a consensus call.
And it's become the hedge against inflation because it is more certain, and it's not just oil. We've been talking about this. It's also gold, which is, again, one of the biggest mysteries as it hits all-time high after all-time high. It's also iron ore. It's all of the precious metals as well well as industrial ones.
We hear analyst after analyst talk about they are overweight, but Stuart Kaiser yesterday was talking about the fact around this table that oil needs to prove itself, that it could sustain these levels. How much of this is temporary, and does the Fed just look through it? It's not part of core.
Crude this morning positive by a third of 1%, 89.74 on Brent, WTI 85.54. The broader price action shaping up as follows on the S&P 500. Some mild days of price action. Monday down a little bit, Tuesday up a little bit. Today totally unchanged on the S&P. Jim Reed over at Deutsche Bank. Lisa, I know you read Jim's work as well. We've gone 7 consecutive sessions without a new record. The longest period without an all-time high since January.
Which is notable, and the only negative thing you can say about a rally that hasn't really gone down very much at all this year. That said, there's been some really interesting price action under the hood. What you've seen is the Magnificent Seven underperforming. NVIDIA, what it did yesterday was fascinating to me. The fact that Intel came out with a chip that may or may not take off. Intel shares, meh. NVIDIA down. There is a feeling that people are trying to hedge some of the high flyers for most of this year.
Lisa mentioned the bond market as well, so let's check in on the scores this morning. Yield's just about unchanged, lower yesterday on a 10-year at the moment, 4.36, on a 2-year, about 4.74. Coming up this hour, Dan Morris of BNP Paribas, as investors await the latest CPI print, Tobin Marcus of Wolfe Research as President Biden meets the Japanese PM, and Bloomberg's George Ferguson with new concerns over at Boeing. We begin with our top story, investors awaiting today's inflation data. Dan Morris of BNP Paribas with this to say: March CPI data will be critical, telling us whether the big increase in monthly services inflation was just a blip and whether goods inflation is returning. Dan, I'm pleased to say, is with us now for more. So Dan, are these bumps in the road or new terrain?
Well, I think, as pointed out, I think from one of your previous commentators, we're nonetheless still talking about a lower level of inflation by the end of the year. So we don't want to get too carried away. Even if it is a bump, no one's talking yet about a re-acceleration in growth or a re-acceleration in inflation or a Fed hike as opposed to cuts. So it is a question about how smooth the path is, but it is going in the right direction. So on one hand, even if we do get that 0.3%, which, as pointed out, would be 3.6, which is not 2%, that's too much, but we do still anticipate it is going to go down, and that's what we want to focus on.
Dan, yields have repriced. Lisa talked about positioning in the bond market. Yields have repriced higher by around 50 basis points year to date at the front end on a 2-year, at the longer end on a 10-year as well. Has the boat become too loaded to the one side in the bond market?
Well, actually, we're looking at steepener, so in anticipation, at least for nominal real yields, probably in the belly of the curve to start going down. So yeah, there is a view that if you think about positioning, kind of where the market's gotten at this point, perhaps it has gone as it does to the other extreme, and at this point we think there is potential to move back in the other direction.
Given that, Dan, this is the reason why some people are saying that if we get an inline print today, or if you get a lower than expected inflation rate, it is going to be a rip-roaring rally in bonds as people go back to this idea inflation's coming down. Would you be an active buyer of duration if we do get a downside surprise?
It certainly would help if you came in at 0.2%. I just don't know how likely that is. I mean, we really, even if we do look at the headline figure, it is going to matter a lot what the components are. I mean, we've talked about owner's equivalent rent, which we know doesn't matter anywhere near so much for the PCE, for the personal consumption expenditures index that the Fed looks at. It is going to be really the stickiness of services inflation. The good news is with the payrolls data we got last week, average hourly earnings continued to fall, so that's good. But the big question mark will be goods inflation, which has potentially started to turn up given the conflicts, the issues we know we have in shipping in the Middle East.
If we do get some sort of rally in bonds, is that going to be positive for stocks? Is that going to be something that does fuel a new leg of the rally? Or is that kind of a question mark around why bonds are rallying and this potential for more weakness later on?
It depends a lot on what's behind either the increase or the decrease, because we know how sensitive growth stocks are to moves in real rates. So if it is a lower print and we put back in some cuts from the Fed, that normally would be supportive for growth stocks. If it is higher inflation, that's not necessarily so bad. It's always a bit of a balance. Okay, rates maybe don't go down so much, but we're at the levels we're at. We've already priced that in. And a bit more inflation, well, that should mean higher revenue. So I think there is a scenario where as long as it's not a weak growth data that we get subsequent to this, equities for the most part should be supported, we believe.
Daniel, you just mentioned transportation problems in the Middle East. Is that really an impact on goods in the United States? Isn't this more of a European problem?
Well, certainly we haven't seen the data yet, and even if you look at the European inflation data that we have already gotten for March, which is actually a positive signal, we shouldn't forget that when we had that initial surprise in CPI inflation in the U.S., we thought it was just a U.S. problem, but then we saw, particularly on the services side, it showed up in Europe as well in January and February. Well, the March data out of Europe was much lower, so if anything, that maybe is a hint, one, that we are going to see a decrease, and whether or not the goods inflation really spreads to the U.S., I mean, admittedly, it's not a huge factor, but low goods inflation has been a big part of the decline in CPI we've had over the last year.
Even though, of course, commodity prices, the prices of crude trickling down to oil prices do not impact core, how are you dealing with this surge in commodities when you're thinking about an uptick in inflation?
Well, looking at it a bit separately, we do like commodities and we are overweight, and we do appreciate, some of that is just, as you mentioned, a hedge against inflation. We know it's also a reflection of the geopolitical risks that we're facing, and not really so much because of an increase in demand, and that's what you want over the medium term, or a reduction in supply over the medium term, to think that prices are going to be sustainably higher. But for now, we do see it as an opportunity.
Dan, let's talk about NVIDIA. Lisa mentioned it. The stock was down at the lows yesterday by close to 5%. It's been a really difficult start to the week. And then we had numbers from TSMC, Taiwan Semi, quarterly revenue absolutely exploding higher. We're talking about the main chip maker to NVIDIA, to Apple, a better than expected 16% rise in March quarter sales. Is there anything to worry about in that space of the stock market?
Well, if we think more broadly about the outlook for earnings for tech, say if you take NASDAQ 100 and look at how much earnings expectations, forward earnings expectations have gone up over the last year, a big chunk of that is Magnificent Seven. A lot of it is semiconductors. You don't see the breadth there really that you do want to see. So to some degree, irrespective of what happens, say, around semiconductors, you want to see some earnings momentum in the other parts of the market, other parts of the growth market, other parts of the value market. And honestly, I think that is a bit lacking at this point.
So what are you doing around that, Dan? Are you basically reducing some of your exposure to some of those tech high flyers and moving into other areas like commodities, like cyclicals?
Well, we do like tech. We're neutral on the U.S., but it's always a matter of where you see the best relative opportunity. So we're more interested in what's happening in China, in fact. So we all know about the valuation story. Are we at the point now that we're at the bottom in terms of the earnings downgrades that we've seen, it seems like years now? If that's starting to turn around and you have those low valuations, that's an example of we see a better place to take a position where you have more upside than trying to necessarily predict what's going to happen to NVIDIA next.
Dan, are you saying you're more constructive Chinese tech than you are US tech? Is that what you just said?
No, we're overweight Chinese equities, and in particularly and importantly, more of the large cap domestic space, A shares, but large cap as opposed to, say, MSCI China.
Interesting. Dan Morris of BNP Paribas. Dan, thank you. Great to catch up. Really strong numbers from Taiwan Semi overnight. I want to talk about the bond market as well. Tom Titsouris of Strategas is going to join us a little bit later. Here's a flavour of what Tom's got to say on fixed income, the Federal Reserve, and policy down in D.C. You do not want to miss this conversation. Washington is committed to run the economy at full employment at all costs until the election, and the Fed is looking for every excuse possible to cut to aid this cause. Strategas in the next hour of Bloomberg Surveillance.
Which is what people say usually quietly and not when they're on air, but the suspicion that maybe this Federal Reserve is biased toward keeping the economy hotter than cooler running into the election. I'm not going to go into that particular thing. He will, and I'm looking forward to it, but it does raise a question about why.
I'm surprised he did.
Well, right, because the question is, what gives people conviction? Is this what's giving them a sense that this Fed's going to cut, even if the data, as we heard from Bob Prince over at Bridgewater, just is not cooperating?
You're exactly right. He said the quiet part that people tell us behind the scenes out loud. But that is why this inflation print is so important, but not just for the Fed, but because of this White House. Because if you're trying to run an economy that is hot, at the same time, try to quell inflation, because this is what continues to come up in polls.
Inflation data, 8:30 Eastern Time. The estimate, 0.3% month over month on core, stripping out food, stripping out energy compared to the previous read of 0.4. Let's give an update on stories elsewhere. Here is your Bloomberg Brief this morning with Danny Berger. Hey, Danny.
Hey, John. At least 3 people are dead after an explosion at a northern Italy hydropower plant owned by Enel. The company says that a fire had impacted a transformer without providing further details. They're Italy's largest power supplier, and they shut the plant down immediately for safety reasons, but local power supply was not affected. Fitch has cut its outlook for China's long-term foreign debt from negative to stable. The ratings agency says that rising economic uncertainties have eroded fiscal buffers. Although Fitch sees government debt increasing in coming years, it affirmed China's A+ rating. More trouble for Boeing. The FAA is investigating whistleblower complaints that the company took shortcuts to ease production bottlenecks on the 787 Dreamliner. The plane maker says the claims are inaccurate and do not represent the work it has done to ensure the safety of the plane. Shares of Boeing are down more than 30% so far this year. Scrutiny of the manufacturing practices have been building since one of the planes experienced a mid-air accident in early January. That's your Bloomberg Brief. John.
Danny, thank you. Again, this comes with a warning. If you're flying this morning and you're flying with Boeing, turn the volume down. Here are the allegations. Factory workers wrongly measured and filled gaps that can occur when airframe segments of the 787 are joined together. The assembly process could create significant fatigue in the composite material and impair the structural integrity of more than 1,000 of the wide-body jets in service. These allegations are quite something.
And then he also said that he had serious acts of retaliation against him, and then the previous whistleblower died of a self-inflicted, supposedly gunshot wound last year. So a lot mounting that needs to be investigated.
Pretty shocking stuff. More on Boeing a little bit later this morning. Up next on the program, US Steel in focus.
The relationship is bigger, more significant than a single commercial transaction, and that's going to continue, whether there's a disagreement on a single transaction.
That conversation up next, live from New York City this morning. Good morning.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rating World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Earnings season is coming.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead is coming out right now.
We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been?
Better than what the street was expecting. Bang in line with estimates.
We will have full and instant analysis.
It all starts Friday on Bloomberg. Context changes everything.
It is CPI Wednesday, the data just around the corner, 8:30 Eastern Time. Equity futures on the S&P totally unchanged again. Such muted price action at the close Monday, again on Tuesday. In between, though, at least intraday Tuesday, some big swings in there. I can't explain them, but they existed. In the bond market on a 10-year, 435.77. Other surveillance this morning, US Steel in focus.
For 4 years in a row, the United States and Japan are the #1 foreign investors in each other's respective countries. In 2021, when there was an election in Japan, some foreign entities were looking at buying Toshiba, and Japan said for national security interests, that's not going to be permitted. So there's a context here. One is that the relationship is bigger, more significant than a single commercial transaction, and that's going to continue, whether there's a disagreement on a single transaction.
Here's the latest this morning. The Japanese Prime Minister Kishida arriving in Washington for the country's first state visit to the US in 9 years. Hanging over the visit, Nippon Steel's planned takeover of US Steel. Tobin Marcus of Wolf Research writing this. Japanese officials suggest they believe their best play is to stay quiet and work with the Committee on Foreign Investment to try to secure a positive recommendation. Avoid putting Biden on the defensive and see if the situation improves after the election. Tobin joins us now for more. Now, Tobin, as we know, a big element of this is to try and secure the vote in places like Pennsylvania. Is that working?
At the moment, I would say it's not working yet. Biden's still behind in the polls across the blue wall states that he needs to win. Polling very tight in Pennsylvania and Wisconsin, a little bit more pro-Trump in Michigan, but I think all well within kind of competition distance for both candidates. So, you know, it has not worked yet, but it is understandable, I think, that Biden and the Biden campaign are looking at that swath of political territory with a very keen eye.
Tobin, do you sense the Japanese understand, or are we at risk of isolating some of our allies?
I think they get it. I mean, I think that we've seen in the response to this situation from Prime Minister Kishida and sort of officials around him in the wake of Biden coming out sort of surprisingly strongly against the deal a few weeks ago, that they understand there's no real percentage in pressing him on it at this point. The company is still very gung-ho on the deal. I mean, you know, you're still seeing lots and lots of, you know, advertising, lobbying focused on DC types kind of touting the economic benefits of the deal. They're continuing to try and engage with the union, even though the USW seems very dead set against the deal. So it's not as if the Japanese side in general has given up, but I think you are seeing at the governmental level, they're not making it their #1 priority. The summit this week is much more focused on security issues and defense cooperation, where I think the mutual interests are more aligned. And, you know, they will try to get a good outcome here, but know that it's not a foregone conclusion.
When it comes to the CFIUS review, what the administration is looking at is whether or not there is this connection to China. Do you think that's warranted?
I think this is all downstream of politics. I think if you were doing a purely neutral, staff-driven CFIUS review with no concerns about politics whatsoever, if this were a company that did not have United States in the name, that had a kind of iconic you know, legacy to it, I don't think authentically that there would be problems. I mean, as we're seeing in the summit more broadly, Japan is probably our most important ally in the Indo-Pacific, one of our most important allies globally. I think Japanese control of U.S. companies in general is not a big security concern. Steel, a little bit of a special case, but I do mostly think that we are seeing an exercise in mitigating the kind of potential political liability of allowing this, again, quote-unquote, iconic U.S. company to be acquired by foreign entity, regardless of where that's domiciled.
And when you talk to Japanese officials, they say actually uniting these two companies would be a force against China. So we're at risk in Washington to create this boy that cried wolf situation when it comes to national security concerns.
Yeah, I mean, you heard Ram talking about this a moment ago in the clip that you played. Like, it's not unique to the U.S. It's not unique to this situation for there to be political considerations or you know, even economic considerations around protecting kind of domestic champions in various different industries. So, you know, again, it's not, I think, the ideal situation. It's not what you'd want as you're trying to deepen both economic and security cooperation with Japan. But I do think that they get it. It's not derailing the other efforts to knit a tighter relationship. Again, the sort of suite of deliverables that are being rolled out around the summit, I think both sides feel quite good about in terms of Japan's, you know, sort of continued shift towards being a full spectrum geopolitical actor in the Indo-Pacific, you know, sort of undergoing their own military modernization and preparing to cooperate a lot more with the U.S. in deterring China.
Tobin, it's getting a lot harder to distinguish politics from policy at this point. And I do want to get your thoughts ahead of an interview that we have later on with an analyst for Strategas, where he came out, and John mentioned this, quote, "It's fascinating to me. Washington is committed to run the economy at full employment at all costs until the election, and the Fed is looking for every excuse possible to cut to aid this cause." Would you agree with that assessment? Is that kind of the feeling that you hear from the clients that you speak to?
So I will say it's a very active debate among my clients and other folks in the DC space, the extent to which Fed decision making this year is politicized. I don't really agree with the notion that the Fed is putting its finger on the scale for the sake of an electoral outcome. I've sort of heard that talking point a lot. I don't really think it's right. But I think Powell's very clear political incentive is to ride off into the sunset as the person who defeated this outburst of inflation. I think he cares a lot more about his legacy, about not being the next Burns, than he does about getting reappointed or the sort of inevitable political attacks that he'll face from both sides, depending on when they cut. If they cut in June or July, they'll be criticized for cutting too early and too much. If they cut in September, they'll be criticized for cutting too close to the election. If they wait until November or December, they'll be criticized for holding rates high, sort of longer than necessary in a way that hurts Trump. So he's damned if he does and damned if he doesn't, I think, in terms of the political incoming he's going to face. I think that their incentive is to try and actually navigate the genuinely challenging set of empirical questions that they're facing around the appropriate path for rates. Not that they'll do it correctly necessarily, but I do think that we are seeing their sort of authentic best effort to try and manage both sides of the dual mandate.
There is this question, though, of course, of whether the Fed comes under attack in terms of its legitimacy in another administration and whether it has sort of an incentive to preserve more of a status quo. Do you believe that? I mean, this is sort of one of the theses, one of the sort of conspiracy theories underpinning this, which is the reason why we hear this so much.
Right. I mean, if you gave Powell truth serum, would he prefer Biden to Trump? Probably. But I don't. He is a registered Republican. It's not as if he's sort of somebody whose track record would suggest that he's going to sort of move heaven and earth to get Biden reelected. Generally, when we look backwards at the record of what Fed policy has actually been in election years in the period since Nixon and Burns, we don't see any good evidence that there's any sort of historical pattern around election interference. You're no more likely to get cuts than hikes in election years. You see, the deviation between the Taylor rule and actual Fed fund rates in election years is, if anything, more hawkish than it is in non-election years. So, I think there's not a lot of empirical track record to point to on this, and I don't really think it makes sense for Powell. Again, he's towards the end of his career. I'm sure he would like to get reappointed, but I do think he cares much more about not sort of mismanaging the situation and going down in history as the person who allowed like a big re-acceleration of inflation, totally failed at the sort of, historically important job that he's facing at this kind of inflection point. So, and again, in terms of the legitimacy of the Fed, they will face quite sharp political attacks no matter what they do. And so I don't think that trying to solve for that really makes a ton of sense.
Well
so
said.
I don't buy this. I hear it a lot. Like the theory is definitely out there, but I'm not on board.
Lose-lose. Type of Marcus of Wolf Research. Super diplomatic. An active debate. It's an active debate. And to his point, doesn't matter when they go. They'll be criticized by someone about something, whether it's June, whether it's right before the election or right after it.
And what he said also is that this Fed chair does not want to go down as history as Arthur Burns. He doesn't want to go down in history as fueling an inflation surge that was akin to the 1970s.
I don't know about retiring, though. Don't you want to go and deliver some $1 million speeches? Don't you want to get on that circuit?
You're just imagining yourself in public policy.
Bramo, if 100%. I could deliver a $1 million speech, I'm not even hiding that if I could. If someone wanted to pay for that, I'm not sure what I'd talk about.
PSA, please, reach out to John.
Then he's going to disappear into the sunset, all right?
Italian football.
top names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
We're going absolutely nowhere. Going into inflation data, equity futures on the S&P unchanged, dead flat. Likewise on the Nasdaq. On the small caps, the Russell. You spot a theme here, going absolutely nowhere. Let's switch up the board and get to the bond market. 2-year, 10-year, 30-year, going somewhere this year, and that's higher, up by something like 40 to 50 basis points across the curve on a 2-year, on a 10-year, year to date. At the moment, just about unchanged after a rally yesterday on Treasuries, 435.77 on a 10-year, on a 2-year, 473.86. I just wonder how much of that was about what was developing in the commodity market, Lisa, where crude was just starting to break lower, break back below 90 on Brent.
That's what we saw yesterday, which is part of the reason why you did see a bit of a reprieve in the bond market, also at a time where people are saying maybe we've gotten ahead of our skis in terms of bearish bets on bonds. There was a hint of that coming out yesterday, even with, I will just note, a 3-year auction yesterday that did not go that well.
I know.
Just want to point that out. And there's another 10-year note auction today at 1 p.m. after the CPI print. I'm curious to see whether it inflects one way or another. It seems like that's what people are waiting for.
$39 billion in 10-year notes. If you're interested, coming a little bit later this afternoon. If you want to buy some 30 years tomorrow, there is $22 billion worth of supply coming to market. That's the Treasury market. And perhaps we compare what's happening there with what's happening in precious metals. The rally in metals has been absolutely relentless. I think in March, gold was up something like 9%. We've had another move, a decent move in April as well, just off all-time highs.
And this really goes down to what Mohamed El-Erian was talking about. We've heard this a number of times. Central banks are buying. China is buying. There is, on the margins, diversification away from the dollar, not necessarily de-dollarization or the end of America as we know it, et cetera, et cetera. Some people might go there. Good luck. There is this question, though, about how much more fuel there is to this and whether it is some sort of indictment on the idea of treasuries as a haven asset.
We were straight with Mohamed yesterday. Was this about sanctions or about Treasury supply? He said this is about sanctions.
He didn't like the term, though, to Lisa's point, de-dollarization. He said, I wouldn't go that far, but it is about the policy and the sanction policy. And you hear this a lot from people. They want to make sure when they're looking at central banks, they think that this is the reason why they are diversifying, putting some more money into gold. Because if this is where the U.S. policy is today, what happens when there's more geopolitical risk in the world, and you know that they can go back to that sanctions policy?
Lots of physical buying. Gold just a little bit softer on the session, down by 0.2%. Under surveillance this morning, our top stories, Boeing's worries continue. A whistleblower coming forward with accusations the company cut corners on the assembly of the 787 Dreamliner, which may, quote, dramatically reduce the life of the plane. The outgoing CEO, Dave Calhoun, being called to testify on Capitol Hill April 17th. Now, sometimes we talk about a grilling and they're not going to get a grilling. I think this guy's going to get a grilling on Capitol Hill.
Absolutely. What we're already hearing from Senator Blumenthal is that Boeing has repeated shocking allegations about their manufacturing failings to a point of an appalling absence. What struck me about this whistleblower is that he's worked at Boeing for 10 years. So he obviously was very committed to this company. So to come out and outline everything that's going wrong, he's clearly very concerned. And it just feels like this grilling is going to be more bad news for Boeing.
Should we get the numbers from Delta?
Well,
They've been super excited about them.
Well, yeah, we did get the numbers from Delta, and I will just say this is connected to Boeing because it really raises this question of whether they can deliver planes that are very much in demand because the demand is very much there. Delta beating expectations, expecting second quarter profit and revenue to still exceed revenue expectations even more. Just giving you this from Ed Bastian, the CEO. Delta expects no let-up in demand. The carrier hasn't seen a dip that historically has occurred before the start of the summer season. Both Memorial Day and early peaks at the 4th of July look quite strong. This goes to the question of consumer spending. This goes to the question of just whether the consumer is still strong. This is classic discretionary spending, and they are spending it. This is the reason why I've been so interested about Delta, because even with all of the hangups, even with fuel prices going higher, they're able to pass it along, and there still is that steady demand, John.
The stock is positive in the pre-market by something like 2.9%. More on that story a little bit later. I want to turn to Apple, continuing its shift away from China. Bloomberg reporting the company is doubling its iPhone production output in India. During the last fiscal year, 1 in 7 iPhones were being made in India, totaling $14 billion US. However, China remains Apple's largest overseas market and iPhone making hub. That might be the case, but you can see quite clearly that D word. They are diversifying big time. You see it in the numbers.
When you saw, I think something like 14% now of their iPhones being produced in India, it goes to this question, are they saying one thing and doing something else? Saying that they're committed to China, they want to remain there, playing the ultimate diplomat. Tim Cook has been that person. While on the other side, just kind of, come on, produce this a little bit more.
The timing of this is interesting because he's just off a trip that he was in China, saying that they're committed to the company, but that 14%, that's 1 in 7. This is the whole idea of friendshoring. And if that's where we are today, where is it going to be 10 years down the line? Because a lot of geopolitics that cloud this story.
That's the latest on Apple. Let's turn to the main event. US inflation data about 2 hours away. The median estimate in Bloomberg survey calling for the core figure to rise 3.7% year over year, making the smallest gains since April 2021. Francis Donald of Manulife expecting this. We expect rising energy prices to keep headline CPI elevated, even as core inflation slowly moderates. Ultimately, we see annual headline inflation hovering around 3% throughout the year, low enough for the Fed to begin cutting interest rates. Francis, I'm pleased to say, is with us now to explain that one for us. So, Francis, let's get to that. We stabilize at 3, yet they're still able to cut interest rates. Can you help us understand that a little bit more?
Well, it comes back to what the Fed has said to us, which is they are trying to land this economy, a soft landing, and 3% by standard Taylor rules, and most of the way the Fed looks at inflation is enough to want to keep those real rates from climbing. What I'm more interested in, though, John, is not how many cuts we're going to get in 2024, but what the totality of this easing cycle is going to look like. For most investors, whether the Fed starts in June or September, frankly, even if they cut this year, is not going to be as relevant as whether we are indeed in a soft landing, it's going to be 3 to 5 cuts total, or whether we're heading towards a recession and it's a more standard easing cycle. I'm in the latter camp. And again, for most investors, that story is far more important than some of the decimal places we'll see today on CPI.
Francis, you've said it repeatedly on this show. You don't get to have your cake and eat it too. You're not getting a soft landing and meaningful cuts. If you're in the other camp, what is a standard easing cycle? Just remind us, because it's been a while.
Sure. Well, we see the Fed heading back towards what they'll consider neutral. Now, we have raised that estimate from 2% to 3%, but this is a central bank that will cut hundreds of basis points if we enter a recession. That is not what is currently priced in this story. And that's why everyone's talking about the inflation number being so relevant. But my eyes are on the labor market and what's starting to crack there. Rehiring activity coming down, wage growth decelerating, and some of the problems we're seeing with consumers. Credit card delinquencies started to rise, and interest rate sensitive pockets of retail sales like housing, electronics, furniture, those are declining over the past year and a half. That's evidence that this economy is really starting to deteriorate. And economies, they don't break in straight lines. They don't break slowly. If that labor market starts to go, it will be in a nonlinear fashion. And that story, to me, is the one that I'm currently watching.
Francis, why, if there is some sort of break, does that mean that inflation is going to come back down far enough for the Fed to be justified to cut by hundreds of basis points? This has been one of the key questions, especially given commodity prices, especially given reshoring, especially given the potential for things like tariffs.
It doesn't, Lisa, and that's the big challenge. Is this is a central bank that is probably going to have to make, as we call them, critical concessions and recognize that they are now at the point, I believe in the next 6 months, where the weight of that dual mandate will start to become heavier. And while we've always said that this was a great thing for the Fed to have a dual mandate, full employment and price stability, a lot of other central banks will not be in that position. Now, I will say that wage growth is coming down and the demand side will probably bring inflation back down. We're not heading back to sub 2% inflation. And so the Fed's going to have to choose. If they have millions of people who are suddenly out of work, do they prioritize that over the 2% target? And whatever that means. Now, some of that is subjective call. And unfortunately, economics and these macro forecasting is in part art, is in part science. But the art component and the interpretation of how the Fed will respond when their dual mandate comes into question, that's going to create, and already is, a huge dispersion in Federal Reserve rate forecasts.
The economic artwork looks like a Rorschach test because, right, frankly, you can read whatever you want in this data. And it's come out consistently showing both strengths in certain places and weakness in the places that you mentioned. We heard yesterday from Mohamed El-Arian, listen to what the companies are saying. This just recently out of Delta, just moments ago, that it expects no let-up in demand. Usually there is a lull in summer travel or ahead of the summer season. They see nothing of the sort. They see very strong travel bookings, and people are willing to pay higher prices. How do you pair that type of message with, on the margins, this idea of delinquencies picking up and small businesses expressing concern?
The U.S. economy is incredibly desynchronized, much more than we have seen certainly in my career, and in some cases the most we have on some of this data record. So CEO confidence at big companies is looking very strong. I mean, that's in a re-acceleration phase. But look just yesterday at small business optimism, or pessimism in this case, which is showing really clear recessionary signals. The goods economy is deflating, not just disinflation, but deflating. Low-income households and consumers are incredibly pessimistic. Why? Because they are borrowers. These are the people who rely on those interest rates to help them. They are very negative. High-income households who are benefiting from the stock market and house prices and are savers, they're doing really well. So it's not so much that one view is right or one view is wrong, it's that this economy is not operating holistically. And even we've seen some data that shows that individual states are really struggling with their rise in unemployment rates while others are not. So the best approach is not to cherry pick from one side or the other, but look at the holistic view. Now, my personal view is that once the labor market starts to deteriorate, it won't matter where you are, whether you're the CEO of a major company or you're running a bodega, you're still going to view this as recessionary. But right now we're in an air pocket where there really is a major desynchronization. That's not playing with the data or interpreting it differently. It's because this economy is different.
When you look at this desynchronization, how big is that gap between high-income consumers and lower-income consumers?
Well, it's sizable, but just a reminder, you know, the top quintile, the top 20% of Americans spend 35% of total expenditure. And this is one of the reasons why, if they're benefiting, the aggregate economy is doing really well. So when we look at things like GDP, our sense is, we've even had these discussions on my team, is it possible we don't experience a GDP recession because high-income consumers hold up that GDP number, but there are pockets that feel really recessionary? Policymakers are going to have to be very sensitive to that because not everyone's reality is going to be the same. Forget Wall Street versus Main Street. This is going to be like downtown versus rural, California versus New York. We're going to see a really wide divergence in economic outcomes across this country by incomes, geographies, and sectors.
Small versus large, small business confidence. Just terrible in the last 24 hours. Francis, thank you. Francis Donald there of Manulife. Compare what we heard from the NFIB yesterday to what we're hearing from Delta. Just to recap those numbers again, as Lisa mentioned, Ed Bastian, in an interview with Bloomberg, the chief executive of Delta, expecting, quote, no let-up in demand. The numbers we got just moments ago, seeing second quarter adjusted EPS is the range 220 to 250, the estimate 223. And here's the price section, Bramo. Delta's up by close to 5%. This is given a lift to American and to United too.
And this talks about the increase in revenues even with higher commodity prices. That's about a third of the cost of the airplane industry really does come from oil prices. The fact that you still have the ability to pass it along speaks to what we just heard from Francis, which is essentially, okay, screaming, rip-roaring at re-acceleration in the travel industry for people with discretionary spending. You take a look at small businesses, you take a look at other pockets, it's completely desynchronized to the most degree that she's ever seen in her career.
Well, just sit on that just for a beat longer. Lisa, small business confidence, optimism, just fell to the lowest we've seen in 11 years. We're talking about decade lows. You pair with that employment intentions, they were kicked lower as well, and compare that to what we're hearing from Delta right now, two very different worlds.
And just to sit on that employment component, they basically had the lowest read on planned hiring going back to May of 2020. I'm talking about small businesses. So completely bifurcated. If you're a Fed and you're looking at this, who do you cater to? Do you cater to the reacceleration story at some of the big companies, or do you cater to some of the smaller businesses and regions that are getting harder hit and say, you guys need a reprieve? It is a tough call.
Delta right now doing nicely in the pre-market, up by 4.5%. Let's get you an update on stories elsewhere. Let's get to your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Atlanta Fed President Raphael Bostic still sees just one rate cut this year, but says he is open to changing his mind if economic conditions change. Bostic says that the U.S. economy continues to show resilience, but he can't discount the possibility that rate cuts have to move further out. But in leaving himself full optionality, Bostic also added that labor market pain would need cutting sooner. TSMC's quarterly revenue grew at its fastest pace in over a year. Of course, thanks to the AI boom. The company's value more than doubled since October 2022. Its outperformance also helped enhance expectations that it will return to solid growth this year after slower than expected post-COVID recovery. TSMC said in January that its AI revenue is growing at a 50% annual pace. TSMC is the main chip maker for both Apple and NVIDIA. ByteDance's revenue is surging. The owner of TikTok reported its profits soared about 60% in 2023. It's the first time that it has outpaced Tencent. It's also outpacing Alibaba too, but the company faces an uncertain future in the US. You'll recall the House passed a bill last month to ban TikTok unless ByteDance sells its prized assets. And that's your Bloomberg brief. John.
Danny, thank you. Some stunning numbers there. Up next on this program, Boeing's deepening crisis.
We're going to approach this, number one, acknowledging our mistake.
We fly safe planes. We don't put airplanes in the air that we don't have 100% confidence in.
That story, up next.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build. So it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is the very definition of snoozy. Take a look at this. Equities going nowhere. Euro dollar going nowhere. The bond market going nowhere. Check back in at 8:30 Eastern Time. Imagine at 8:30 Eastern Time when we get CPI, we're going to start going somewhere.
Literally right now, people are just sitting on their hands. What reason would anyone have to move? The bets are in. You wait for the casino to open. Let's go.
435.97 on a US 10-year this morning. Under surveillance this morning, Boeing's deepening crisis.
I got kids, I got grandkids, and so do you. This stuff matters. We're going to approach this, number one, acknowledging our mistake.
We fly safe planes. We don't put airplanes in the air that we don't have 100% confidence in.
This stuff matters. Here's the latest. Boeing 787 now under scrutiny. An engineer claiming the plane maker took shortcuts to speed assembly of the aircraft, and the issues may, quote, dramatically reduce the life of the plane. Boeing calling the accusations inaccurate. George Ferguson of Bloomberg Intelligence joins us now for more. George, can you talk to us about the allegations, the nature of them, how serious they are?
Sure. Good morning. So they're just emerging, so I think we're just getting our arms around it. What I will say is, they're talking about the mating of the fuselage of the 787. And previously we had Boeing disclose and work with the FAA to fix shimming problems they were having with the 787. So I think the beginning of this, I'm wondering if this is part of that same problem. What I will say, though, is the 787 is an extremely important airplane to Boeing, second most important after the 737. This is an airplane they've collected a lot of orders for lately. They and Airbus are in the marketplace, I'd say, pretty hard right now, working both the A350 and the 787, because these are they're the smaller wide bodies, but the next highest volume programs. If they can push these programs up to higher build rates, that would be a tailwind for profits, for cash flow. So as the second most important airplane to Boeing, very important, very concerning. But again, wondering a little bit if this is something we've already visited. I think that's why the FAA is jumping in pretty quickly to figure out whether this is part of that shim problem Boeing had previously.
Well, let's work through the allegations. So factory workers wrongly measured and filled gaps that can occur when airframe segments of the 787 are joined together. The assembly process could create, quote, significant fatigue in the composite material and impair the structural integrity of more than 1,000 of the wide-body jets in service. So let's talk about the airlines, George. If you're waking up, if you saw this playing out yesterday afternoon, and you're an airline with some of these planes in service, how do you react to this morning?
So again, I think very concerning, but what I'm hearing in what's been released so far is it could affect longevity down the line. So today, I think operations aren't affected. You drive on, but you're concerned about an asset you probably paid $130 million-ish for. You're concerned about, your long-term ability to use that airplane. And again, you have another Boeing quality problem potentially on your hands. You'd hate to have that, but you could have that.
It also raises a question about new orders at a time when demand is going through the roof. I mean, we just heard from Delta coming out. Expectations beat Wall Street's forecast. They also talk about second quarter coming in robust and no sign of a slowdown, typical for this type of season. How much can we expect airplane tickets to go up, prices to go up, just simply because of a lack of deliveries of new planes, lack of capacity, and an incredible amount of demand?
So I think there's a big debate in the marketplace right now if there is a lack of airplanes, if that will filter through into the marketplace. For sure, Delta would be one to gain from the problems at Boeing. If you're a Boeing fleet, you're not getting airplanes as fast as you'd like. You're not going to compete as much with them, so it could help them. What I will say, though, Delta's earnings were nice, but if you look at their yields, it's the price paid per mile flown by a passenger. The yields weren't great. They were actually down year over year. And if you look at sort of the bifurcation of that, if you look at the sort of the basic economy customer, the income for them grew 4% against capacity that grew actually not capacity, but against travel that grew 9%, or revenue passenger miles, which is essentially all the miles they put in the air that were filled. That grew 4% for the basic traveler. It grew 10% for the premium traveler. So what I'm trying to tell you is it still looks like the basic traveler, there might be too many seats in the marketplace. If you look at Delta's domestic yields as well, price paid per mile flown, by a traveler, those were flat. So right now, what we're not seeing fares rise significantly. We'll see as we get into the summer season. They guided forward. Their guide was an operating margin that would be below last year's operating margin. So while the profit looked good, it beat expectations. What I'm seeing is higher load factors out of Delta, and maybe fares, especially for the basic traveler, aren't as good. They're flat-ish. and they're much better for the premium travel.
This is fascinating, George, especially given what Francis Donald just said about an incredibly bifurcated economy. There's no better microcosm of that than airlines and flying, where basically some people are put in the back and they have to board last, and you don't have any room to put your bags. And then people up front get, you know, incredible meals and have great space, and you pay up for it. Are you basically saying that people in the back are actually becoming much more price sensitive and are having a harder time justifying high costs, and they're seeing less revenue? The people in the front are doing just fine, and that's essentially what you're seeing, and a lot of these airlines are going to count on the people in the front a lot more.
That's what it looks like to me. So, yeah, I think as we go into earnings season, this bodes well for United and American as well. If you've got premium seats, I think you can sell them at good ticket prices. Those folks are willing to pay for comfort. Yeah, and if you've got economy seats, I think it's going to be much more challenging. A lot of them in the marketplace, a lot more price sensitivity. Like you said, I think it goes to that two-speed economy.
So it sounds like they're operating in a more efficient way and not exactly growing. How does Delta grow from here? Do they offer more premium for those high-end consumers?
Well, so we're seeing that across the industry. If you could put premium in an airplane, you are. Some of the ultra low-cost carriers are offering, taking the middle seat and blocking it out so they can find a way to create a little more premium and a higher price point for the seat. So that's one of the ways. If you can get premium in, more premium in, you do it. The other thing is, if you look at Delta load factors, they were quite nice during the quarter, 83%. So the airlines are kind of pushing getting that airplane as full as possible, right? If you're not getting exactly the ticket price you'd like, if it's a little softer, you just make sure you fill the airplane more. I think we've all seen it when we travel. The airplanes seem to be full every time we pull away from the gate. That's another strategy for improving revenue and obviously improving profitability, because you're putting close to the same cost against a higher revenue base with a fuller plane.
George, this was brilliant. Appreciate the update. George Ferguson there of Bloomberg Intelligence. Delta right now by close to 5%. Just a public service announcement, just quickly. Nobody on the plane gets a good meal. Okay, I don't know where you got that from. No one on the plane.
Okay.
Nobody on the plane gets a good
second.
meal. What are you talking
Relatively
about?
speaking, you're sitting in the back with a bag of Cheez-Its and the kids looking and spilling their drinks.
I'd rather have the Cheez-Its than the slop they serve at the front of the plane.
I thought you like one airline's food. There's one airline.
JetBlue, great food. No, JetBlue, and Air Italia, yeah.
Honestly,
Air Italia is then
I see someone with a very small violin over there, just...
JetBlue, great food. Just in case anyone's flying business and they're interested. Look, what we just heard there is really, really critical, and I think you can extend that to the broad economy. Flying up front, flying in the back, two different worlds.
And that really is the perfect microcosm, considering that it's basically a tiered economy for everyone to see. If you're special, privileged, come on up, we'll usher you in. If you're not, you've got to check that bag. You don't have room for that bag. Come last. Your kids, and that's basically where we are. And they have very different realities financially.
This isn't new, though. This is a trend, right? The push towards premium, the higher margins. This has been a story for a while.
This has, which is the reason why international travel has been more lucrative, and the carriers that are less domestic and more international have done better. Just as interesting to see how the bifurcated economy is playing out in real time in the earnings and how they adjust.
The Delta in the pre-market doing better than good. Coming up next, in the next hour of Bloomberg Surveillance, Amy Wu-Silverman of RBC Capital Markets, Bloomberg's Enda Curran, and Mandeep Singh alongside Tom Titsouris of Strategas from New York City. This is Bloomberg.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now. What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
This move in commodities, I think, is the real deal now. This has been years in the making.
So the move we got in oil, I think, was very telling from an inflation perspective. We are worried about the surge in commodity prices. But
that will continue and push certain kinds of commodity prices, for example, specifically on copper that we've seen.
We upgraded our view on gold. Why? Because there's now two-way risk on inflation.
Look longer term. The world is changing in a way that the markets right now are not even looking at.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Inflation data 90 minutes away, live from New York City this morning. Good morning, good morning. The second hour of Bloomberg Surveillance begins right now with your equity market on the S&P 500 barely positive by 0.1%. A read on U.S. inflation and a big question, just how strong is the U.S. economy? This from Ed Bastian of Delta speaking to Bloomberg, expecting no let-up in demand.
And this really stems from what we just heard from George Ferguson, where it is such a bifurcated economy in so many different ways, splintered in terms of who has money and who is spending and who doesn't, which raises this question, what does this Fed pay attention to? Is CPI going to call their hand when looking at some of the weakness that we're seeing at small businesses with consumer delinquencies and some of the other metrics that people are pointing to?
Delta Airlines are making money. A new range for the second quarter. The adjusted EPS 220 to 250, the estimate 223. The stock, Anne-Marie, higher by more than 4%.
Higher, but to Lisa's point, the bifurcation of the consumer, the people sitting in the front versus people sitting in the back. I go back to yesterday's small business survey, and the chief economist of the survey came out and said inflation, once again, top of the issue to Main Street businesses, and that goes ahead into the CPI report today.
But this raises this question about whether whether inflation will actually call the Fed's hand, right? And when we talk about this strength, pockets of strength, but pockets of weakness, are they going to be paying more attention to the inflation side of the mandate, or at this point is the priority on the strength of the economy and just this idea of employment remaining resilient for longer? That's what I think the market is grappling with, and frankly, it seems like they think that this is a Fed that is much more heavily weighted to the employment picture.
Steve Rashuda of Missouri is going to join us in 90 minutes' time. Now, Steve's been saying repeatedly, this Fed wants to cut. Will the data cooperate? Will the data cooperate? And how many bumps in a row can you get before you stop calling them bumps in the road? Are we going to get one too many later this morning?
I love that comment from Priya Misra. Basically, is bump the new transitory in terms of some sort of failed concept. The issue is right now the market is set up for a more bearish tilt. It's set up for this idea of inflation running hotter, although along with strength. What is the biggest surprise to this market? What is the potential bigger reaction if there's an upside surprise or a downside surprise? What I've been fascinated by is I think it's a downside surprise because everyone's going to say this is an excuse for the Fed to go. That's amazing. This is the all clear to them, even if inflation is still running hotter than expected. But if you look at the positioning, it seems like that's the balance of risks to rally further.
Well, as you've said, you always have to look at it relative to the positioning, and we've been talking about how short maybe things are in treasuries at the moment. If you want the estimate, we just put them on the screen. We can do that again. 0.3%. Stripping out food and energy month over month is the estimate. The median estimate in our survey here at Bloomberg, the prior number was 0.4. Equities, your scores look like this on the S&P 500 this morning. Equity futures just about positive. On Monday, we were down a little bit, then up a little bit on Tuesday, now up a little bit on Wednesday. Really, really muted price action going into this inflation data. Your 10-year, 435.57, yields going absolutely nowhere, and the euro basically unchanged against the dollar at 108.63. Coming up this hour to discuss, Amy Will Silverman of RBC on why the left tail is waking up.